And with it, if there is a higher risk of rising unemployment than rising inflation and the policy rate is well above neutral, a large upfront move makes sense. The high end of the central tendency, the range for neutral is 3.5%, and so a 50 basis point move would still keep policy in a restrictive setting. If the Fed is offside, maybe by as much of 100 basis points, it's time to get a move on. My words at the end there, but ultimately the sentiment's the same.
If they do that, I'm curious how much they're going to address the neutral rate, how much they really discuss the destination and whether their dot plot and the third part of the act or second part of the act of the economic projections when they come out, how much they elucidate the Fed's new framing of where they're going. Because what we saw in Jackson Hole was not a lot of discussion about that, maybe 3.5%, maybe 3%, who knows? But there wasn't necessarily a focus as much on naming what that destination looked like.
Chairman Powell did something really clever in Jackson Hole, Wyoming. He set a threshold for the whole committee to be judged by. He set a threshold for them, which means they're sort of constrained. He basically said, and we all know what the words were, we do not want to see or welcome any further cooling in the labor market, right? So everyone's got to abide by that. So when they sit around the committee, when it comes to the middle of September, next week at the decision, they have to look back on the labor market data of the last few months and make a call. Have we seen a cooling in labor market conditions, yes or no? And is that desirable? And the answer to that is, yes, we have, and no, it's not. So we should do something about it.
How much? And now that's the question. Right now, that's the reason why the debate is between 25 and 50. There's a question of whether this will spook the market. It seems like fewer people are mentioning that, actually. Fewer people are actually talking about the fact that this would actually be a negative signal to markets. And yet, you have to imagine that at some point, there's a question of whether it's too much weakening. I don't know. I'm personally thinking that when do you start worrying about inflation again?
That's your call? You think that's what gold's reflecting this morning?
Yeah, I do. I think that right now there is a feeling that this market might be baking in a overly complacent feeling about inflation at a time where small businesses are still saying that's their preeminent concern, and you're still seeing housing costs remain high.
New all-time high on gold again this morning. Up next on this program, Tiffany Wilding of PIMCO, Troy Gajewski of FS Investments. From New York, this is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
As we spend some time here on the broader presidential race.
Let's focus in on European politics. makes you wonder how politics might play out.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
60 minutes away from the opening bell, equity futures on the S&P 500 look a little something like this, just about positive by 0.2%. I tell you what, last week just feels like ancient history. The worst week of the year on the S&P 500, bouncing back and going towards a week of gains. On the Nasdaq 100, Bramo, we're looking at the best weekly gain of the year so far, a move of 5%. People are sort of downplaying the importance of NVIDIA and this big rotation that's going to take place. Jensen Huang, a few words, the CEO over at NVIDIA, and you've had a major move on that stock this week.
People have been trying to move away from this and viewing it as healthy, and they just can't get enough because at the end of the day, I mean, we just heard it basically from Will Stein that what you see is their earnings are keeping up with their stock price that's surging so much. Question about whether the rotation will continue, though, in a more significant way, not necessarily with underperformance, but just outperformance of small caps if you do get that that outsized rate cut.
Outperformance on the small caps this morning, the Russell up by about 1% on the Russell 2000. There's some of your index level movers. Let's get you some stock movers with Manus Cranny. Good morning, Manus.
Jonathan, good morning. Yeah, it seems as if we've moved off that buy the dip to incremental FOMO. 5 days ago, we started this show with this stock bid on the prospect of a deal between the unions and management. That unfolded overnight. 33,000 machine workers going on strike. 25% is the pay deal that's on the table. But here is the thing. This is a company burning through cash. We've gone from the euphoria of Monday morning to the reality of that strike coming to bear. If they go out for the average strike, 50 days, you're looking at 3 to 3.5 in terms of the additional cash burn. They can't afford that on the credit outlook. So we started from the ecstasy to the agony of Boeing. Have a look at this. Oracle, if you really want to go beyond the Mag 7 and understand who is eating into the cloud pie, it is Oracle. Basically, this stock was up 14% to the close last night. We're now up 20% for the 5 days trade if we finish up 6.4% today. It's a vigorous guidance again from this company that they are making inroads in the cloud business. Guggenheim have a price target of $200 on this stock. So the momentum is with Oracle. Let's close it off with Adobe. What do you not want to hear from the guy that runs all the innovation around AI? And this is what has happened. The AI guidance here, use our AI. It's not about monetizing our AI. That is not what the market wants to hear. The market does not have the patience for get used to my AI. The market wants you to adopt, use, and monetize. And that is not what we heard from Adobe overnight. Morgan Stanley still stick with $660 on the books. Jeffries are still there at $700. So it's not the guidance in terms of profitability. It is the AI delivery story. Jonathan.
The language matters. Manus Cranny, thank you. Not a pretty chart on that stock this morning. A pretty chart for NVIDIA. That name this week is up by almost 16%. That is a cool $400 billion of market cap added to that name this week. Isn't that amazing?
Well, if you said words matter, you know, use, not necessarily adopt, well, you know, anxiety by our clients, boom, 16% rally. That's what you see in NVIDIA.
What a stellar run for that stock. That's the move on NVIDIA. Let's talk about the moves we've got to see over the next week. A busy slate ahead with retail sales and a Fed decision next week. Tiffany Wilding of PIMCO saying we are heading back to pre-pandemic conditions. Developed market economies now look more like they did in 2019 than at any time since the pandemic. In that context, we think the more relevant question is this: why are interest rates still well above where they were in 2019? Tiffany joins us now for more. So Tiffany, you've got to give us the answer. What did that conversation sound like at PIMCO this past week?
Well, I think the bottom line for us is certainly interest rates are coming down. The Federal Reserve, I think, has also been very clear about that. Powell, when he spoke at Jackson Hole, I think acknowledged the fact that monetary policy now probably doesn't reflect the underlying conditions in the U.S. economy. And if you look at the labor markets, we don't think that the U.S. economy is in recession, but nevertheless, the recent loosening in labor markets just suggests that there is some possibility for overshooting on that side. And in that kind of vein, the Federal Reserve should be focused on moving policy rates back to neutral. And I think the question at this point is just how quickly they get there. We think they probably will revise down their own estimates for the rate path in September. We're looking for a 25 basis point rate cut, but for them to really signal they're going to do a sequence of cuts here.
Tiffany, tell us where you think neutral is. If they revise the path down, what is the path to?
Yeah, I mean, I think that's a great question. So the Federal Reserve still believes it's between 2.5 and 3 on a nominal basis. And I think ultimately that's why they will get there, with not overnight. They're not going to move the policy rate there overnight because they're not exactly sure where it is. And when you're not sure, you want to just go slowly. Now, how slowly, I guess, is the question, and it's about balancing risks. You obviously don't want to take the economy into recession because your policy is too tight. We think a reasonable kind of baseline for them is to kind of write down a median rate path of kind of 3.5% by the end of 2025, could even be a little bit lower than that. And so that's the kind of pace, every meeting type of pace over the next several meetings to see how the economy responds, and then they can reassess and make a further decision from there.
Tiffany, we've been talking a lot about 25 basis points or 50 basis points on Wednesday. And before we get into the guessing game of how you interpret the tea leaves that have come out of a number of publications overnight, I am curious about how you will be gauging the trickle-through effect to the real economy of whether they cut 25 or 50. How will you understand how that's being sort of deployed in the real economy?
Yeah, well, I mean, I think if a 50 basis point cut is if they end up doing it, it suggests to us that, or would suggest, I think, that they're more worried about downside risks to the economy, and they want to kind of more quickly get to neutral. We've said they've achieved a soft landing. Now, really, it's going to be about sticking that soft landing and keeping it going. And I think, again, the question is about how quickly they know they need to get to neutral. How quickly do they get there? So that's how we would be reading. I mean, we still think a 25 basis point rate cut is probably reasonable here. We don't think the economy is in recession right now. Certainly the labor market indicators, are worrisome, but we have had this big surge in immigration that is kind of blurring the picture with some of those indicators. So, I think there's a lot of things they have to take into consideration here. So again, 25 with a sequence of cuts that they signal seems reasonable to us.
Just what I'm trying to get at is what's going to be the actual implementation of lower rates in the economy? Will you be looking for some sort of significant uptick in small businesses borrowing? Are you going to see increases in consumer borrowing or reductions in, say, some of the delinquencies as people's borrowing costs go down? What are the sort of signs that this actually is working at a time where the efficacy of monetary policy has been profoundly questioned as rates went up? And now the question is how quickly it'll be implemented on the way down.
Yeah, I mean, I think if you look at the household sector, we've been talking a lot about this as well. Households just haven't really felt higher interest rates. Many of them have low rate mortgages that they locked in to 30-year periods during the pandemic. So the household sector probably won't feel a lot of it, unless you have new home buyers or first home buyers. But where I do think it could be potentially helpful, is in terms of housing supply. So we've all known that we've been in a period of underbuilding relative to population growth over the last decade post-pandemic or more, and that's resulted just in supply-demand imbalances in the housing market, which suggests to us that as you have rates coming down, you can have real residential investment that picks up. That's obviously going to be helpful for the economy. We think housing investment probably subtracted 1.5 points from GDP in the third quarter. That's a pretty big subtraction. So just getting that back into some modest growth, we think, is probably helpful. And you could certainly get that as you have rates coming down.
I'm glad you mentioned housing. There's been this debate on what actually will happen when rates come down. Will people start moving and more supply will come on the market and costs will come down? Or potentially, will we actually see housing prices go higher?
Yeah, I mean, so in terms of the moving and the existing home sales and things like that, when people move, they usually move from one house to another. So in terms of the aggregate supply picture from that, yes, you get more churn in the market, but it's not on net really that it shouldn't increase by that much the overall supply of homes. What increases the overall supply of homes is new building. And so that, I think, is really the key. Building, has been slow and sluggish this year because interest rates are elevated. Many builders you talk to say the economics are, make less sense with higher interest rates. And so when rates come down, we do think that, building will accelerate somewhat. And I think that's ultimately good for the economy. It's good for the supply-demand imbalances. Eventually, hopefully, that helps to moderate housing prices. Although we don't think that they drop, housing prices will probably be, kind of 5% type-ish ranges. But again, I think that's not necessarily a bad thing for the economy.
Tiffany, and just circling back to what Lisa alluded to, some of the tea leaves that are coming out of things like the Wall Street Journal or the Financial Times, if the market is now presented with potentially next week the Fed going 50 basis points, does that mean now there's outside weight on retail sales next week?
Well, certainly, I think if retail sales next week is bad, is much worse than expected, I think that would maybe potentially increase some probability. I think if you just kind of take the broader range of data that we've gotten over the last month or two, labor market data, in our minds is important, and the labor market data that we saw, it wasn't great, but it wasn't terrible either. So it does suggest that labor markets are slowing, and I think the Federal Reserve wants to try to understand what's going on there a bit more. The slowing that we've gotten over the last couple of months, I think, has been more pronounced than many people expected, both in payroll growth and, of course, the unemployment rates ticking up. So I think, they probably look at that and they say, we are a little bit concerned about that. And if you're concerned about payroll growth slowing, the labor market slowing, of course, you'd expect consumption to be slowing as well. So they probably will be looking at retail sales and those consumption indicators, to kind of confirm or deny, if you will, whether the labor market slowing is having a broader impact on the economy.
Tiffany, appreciate the update. Thank you. Tiffany Wilding there of PIMCO. Looking ahead to next week, the data, including retail sales, going into that Federal Reserve decision, 25 or 50. But the nuances beyond September, I think, is so important. I don't think we can overstate this enough. When we sit here next week and talk about a September rate decision, we'll have a conversation about 2025 with very limited information about policy in Washington. When we sit here for the next meeting on November 7th, we'll have a much clearer picture, we hope, of what policy might look like in a 12, 18 months, the next 4 years possibly, and it could be a very different conversation.
You've mentioned this before, though. How often has the Fed moved ahead of actually policy getting passed versus just the suggestion of it? And this is a tricky moment because people say that fiscal could ultimately change it. And you know why? Because it could be inflationary. This is the reason why I think that is potentially one of the bigger risks being built into the market is the balance of risks and how this market, how much it's sort of moved past inflation, maybe before the proof isn't really shown.
When it comes to fiscal policy like the tax cuts, that's going to be a long, drawn-out debate. When it comes to tariffs, that could be almost immediate. And I go back to what Mike Schumacher said to us earlier this week, which was basically, if you get a Harris administration, the Fed could cut more because she's not going to put up the walls as high as Donald Trump. But if you get Trump in the White House and he decides to put up the walls immediately, and he could do so unilaterally, potentially are we looking at a Fed that might have to recalibrate and start hiking again?
We could have a very different conversation at the Federal Reserve's next meeting after this one in September. Joining us now to discuss is Troy Gajewski of FS Investments. Troy, good to see you, sir. As always, welcome back to the program. Before we get into the markets, let's talk about the Federal Reserve. What's the base case for you and the team?
Yeah, so 325 basis points cuts. We came into this year thinking 2 to 3. There was some overreaction, obviously, early on that there'd be 6. And then when the inflation data came hot in Q2, some folks were arguing for none. But, it's almost a certainty at this point that we're going to get 3 cuts. Clearly, the labor market's softened. There's no doubt about it. Inflation's gotten much more under control. That's the right policy response. And I'll tell you, when you think of credit investors like ourselves or originators of private debt, we're more than happy to trade off some degree of incremental income to further reduce the risk of a recession going forward. And so that's where we're at in the economy, and it's going to be an appropriate response. To your point before, it's now about next year and the year thereafter where there's much more uncertainty.
Yeah, much more to play for. Troy, I want to get to the quote from Tiffany Wilding just moments ago from PIMCO. When she said this, and I'd love your reaction to it, developed market economies now look more like they did in 2019 than at any time since the pandemic. In that context, we think the more relevant question is this: why are interest rates still well above where they were in 2019? Troy, what's the best argument for that, do you think?
Yeah, so when you think longer term, right, arguably the biggest reason why we should have more sustainable inflation going forward than we did pre-pandemic, and particularly in the post-GFC realm, where, as we all know, the Fed was struggling just to get inflation too, it is a much globally tighter labor market, right? You think of places like Japan or even China now, declining working age population. The U.S. labor market has gotten much more structurally inefficient. So that's arguably reason number one. And then reason number two, of course, is this really desire to onshore production. Obviously, we're going through a period of protectionism. So, you know, I think that debate is new terminal rate 2.5 or 3. We can debate that quite vociferously. However, it's certainly not 0 unless we have some type of major exogenous shock that is unforeseen.
There is this question right now of how much we can really count on just sort of inflation continuing to diminish. And I just want to build on what you're mentioning. How are you how are you sort of countering the assumption in markets that inflation is dead in terms of more contrarian investments that push against that?
Yeah, you know, I don't think we're arguing, or most rational market participants are arguing that inflation is dead. It's just that we've made significant progress. And the balance of risks is now much more symmetric between the labor market and inflation. But in terms of counter-cyclical to that thinking, there's really nothing specific there. However, you know, opportunistically, we have to look across markets and try to find areas where there's more inefficient pricing. So, for instance, if you look at most spread product, whether it's high-yield bonds or levered loans, and even in on-the-run private credit, spreads are relatively tight. They're a little bit tighter than they were coming into 2022. You still have very attractive yield. However, if you look over at public markets, what you're seeing is markets are pricing about a 22% probability of deal breaks in each individual deal and mergers. Historically, over 10, 20 years, it's been 5. Even in this environment, it's peaked at 8%. So we're trying to identify inefficiencies like that we can take advantage of in our liquid strategies.
I know you focus on illiquid strategies and some of the private investments. You're talking about merger arbitrage. And let's go there, because this is actually one area that a lot of people don't want to get caught dead in, just simply because a lot of these deals have been broken. And we have seen a very different FTC under Lina Khan. How can you have confidence to go in and bet that deals are going to get done now, given how politicized so many of these deals are actually getting?
Yeah, well, I think, again, that gets back into pricing. Let's say, for instance, markets are pricing in 12 or 15% probability of deal breaks, and the historical average was somewhere between 5 and 8, depending on how aggressive the FTC was or not. It would be a different story. But as an investor, you're always trying to look at market mispricings versus empirical data. And this is one of the more glaring. And we're not going to say it's an overreaction to your point, a very active FTC. It's just presenting itself with a very attractive theme over the next 12, 18 months. And I think at this point, regardless of the political outcome in November, that looks like a very attractive risk reward to us relative to other strategies out there.
Interesting. Troy, it's good to hear from you, buddy. As always, Troy Gajewski there
Great to talk.
of FS Investments. Thank you, Troy. Appreciate it. The personnel changes down in Washington. Big deal for this market.
Yeah, we have to see what happens. You know, J.D. Vance was one of those individuals that thinks Lina Khan is actually doing a decent job, and he looks across the current Biden administration. We should know we've asked Chair Khan to come on Bloomberg a number of times. I've met with her before privately in the past. And, yeah, we still welcome her appearance.
Still no appearance?
Still no appearance.
Disappointing. Disappointing. I have to say this, though. Vice President Kamala Harris, based on reporting, also facing pressure to get rid of Khan. And not exactly coming out and vocalizing her support for her either, is she?
We don't have a clarity on exactly what this merger policy will look like, or what the FTC will look like, which is one reason why a lot of people are wondering whether you see a surge in mergers that do get completed after the election, regardless of who gets in the White House.
Yeah, this started with the conversation earlier this year, at the very beginning of the year. Do you remember with Brian Moynihan of Bank of America?
I do.
Who made this point about deal flow being held up by the fact that we don't know what kind of deal gets through Washington? It's a problem.
I mean, I think Kroger's and Albertsons was sort of the key example. If they're looking at trying to compete against Walmart, if they're looking at trying to compete against Amazon, and if they can't get a deal done because they're being held up as somehow creating more expensive groceries, that creates a real issue of what the threshold is at a time when you have a lot of banks that are potentially going to look to merge and other sectors as well that are looking for a certain economy.
Do you remember the handbag transaction? What was that? Do you remember that one?
That was with
Capri, wasn't it?
Capri, yeah.
Yeah, coaching, no handbags, that was a problem. Do you remember that one?
Handbags are a problem, groceries are a problem,
groceries
airlines
make
are a
sense.
problem.
I can understand the sensitivity around groceries and airlines. The sensitivity around luxury goods, I couldn't get my head around at all.
Clearly you don't have handbags. You should just try a little bit more.
Worried about entry-level luxury down in Washington. Makes sense of that.
That's the reason why people really are having trouble understanding what deal could potentially get done.
Let's give you an update on stories elsewhere. Let's move on to your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. United Airlines has announced a deal with SpaceX's Starlink, where Elon Musk's company will power their in-flight Wi-Fi. United is now the first major carrier to use the satellite system, becoming a marquee customer for Starlink. The airline said in a statement that it will begin testing the service early next year, rolling it out later in 2025. The yen strengthening this morning for a fourth consecutive day to 140 versus the dollar, the strongest level of the year. Traders told us that hedge funds are in the options market, putting bullish bets on the yen against pairs like the Aussie, Swissy, and offshore yuan. Bank of Japan speak that signaled more rate increases will come has helped the yen advance about 14% versus the dollar since the end of June. Economists surveyed by Bloomberg say the Fed is likely to cut 3 times this year, each by a quarter point. Only a few of the 46 economists surveyed anticipate a larger half-point reduction at the November-December meeting. However, respondents do think that policymakers will pursue a more aggressive rate cut path in the years ahead. And that's your brief, John.
Danny, thanks for this morning. Have a great weekend. Up next on the program, we'll set you up for the day and the week ahead. That's just around the corner. From New York, this is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, created, when you're solving a problem that's real for you and therefore real for the consumer.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Counting you down to the opening bell, here's the trading diary. The week ahead, your agenda, the calendar at 10 a.m. Eastern Time. We'll get UMich consumer sentiment data at noon. Donald Trump holding a news conference in California as Kamala Harris prepares for a rally in Pennsylvania. On Tuesday, the data kicks off, its retail sales, and the FOMC two-day meeting begins. On Wednesday, it concludes. A Federal Reserve rate decision followed by a Chairman Powell news conference happens on Wednesday. We'll get some forecasts as well. On Thursday, another round of jobless claims. And on Friday, a rate decision from the BOJ. With us around the table, Mike McKee. Good morning, Mike.
Good morning.
Let's get into this. What do you make of some of the recent commentary, the shift back towards 50, it seems, at the Federal Reserve?
Wish being father to the man, I'm not sure exactly. Obviously, we had stories in the Wall Street Journal and the Financial Times yesterday that suggested that it's a close call. I don't think anybody would argue with the fact that it's a close call. It doesn't, if the bottom line question is, did Jay Powell call up and tell them what they're going to do? No, I don't think so, because both stories were rather ambiguous about it, but it does raise some questions in people's minds. So maybe loosens up the mark a little bit in case there were something. But we're still a long way away from Wednesday, and we have retail sales coming up. I know you were talking about that earlier, and that could be something that pushes the Fed one way or another as well.
Do you think that the Fed welcomes or pushes back against the idea that people don't know whether certain things, articles, are tea leaves or whether they are just simply reflecting the market discussion?
Well, I mean, if they are leaks from the Fed, it's a deliberate effort to steer the markets. And we saw that back in June of 22 when the Wall Street Journal got a call from the Fed and published a story that basically pushed the markets into the 75 basis point cut because the Fed doesn't like to surprise markets. But in this case, you've got a situation where now it's not going to be a surprise if they do 50 or 25. It's just that we haven't in so long had a live meeting where it could go either way, where what they do matters as much as what they say.
How much focus do you think, besides Jay Powell, is everyone else on the FOMC looking at stories like this when everyone came out and basically said, yeah, it's going to be 25 basis points, and now there's starting whispers of maybe it's going to be 50?
I don't know that they really pay a whole lot of attention to it. If it were a leak from somebody, then that person would be paying attention to it. But this is the day, the Friday before the meeting, when Jay Powell gets on the phone and speaks to everybody one after another and kind of takes the temperature of where they are. That was his goal. But I think each one of them comes into the meeting with their views fairly set about what they're going to do, because they have to make a decision. So they've been sitting, especially the bank presidents, have been sitting with their economists and people in their banks and coming up with a decision for each of them to bring into the meeting.
It's the first live meeting in a long time, and I can't wait to see the back of it. Michael McKee, thank you, sir. Coming up on Monday, I'm sure everyone feels the same. Laurie Calvasina of RBC, Savita Subramanian of Bank of America, PIMCO CEO Manny Roman, and Megan Robson of BNP Paribas. All of that to come next week. From New York, thank you for choosing Bloomberg TV. Have a wonderful weekend. This was Bloomberg Surveillance.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
What prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are three fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number two, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is that you take the tumor out. And then number three, They make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
All right, stocks trying to hit 5 straight days of gains. It certainly feels like a while since we've seen that. 30 minutes until the start of trading. I'm Katie Greifeld.
And I'm Shonali Bassick. Matt Miller is off today, and Bloomberg Open Interest starts right now.
Coming up, it's 50 versus 25. Economists split on how the Fed will communicate next week's policy action. And no deal. Boeing shares are sinking as factory workers walk off the job for the first time in 16 years. And sticker shock. We'll speak to the CEO of Spartan Nash as consumers across the nation grapple with increasing grocery bills. 30 minutes to go. Let's take a look at where markets are trading right now. And like I said, a little bit of green on the screen. Of course, that would be 4 straight days of gains, 5 straight days of gains for the S&P 500, which we will show behind me at some point. Of course, we saw 4 straight days of losses to start September. We'll see, of course, if we can keep the momentum going on the S&P 500, currently up about 0.2%. The NASDAQ 100 can't really decide what to do. Your big tech stocks currently unchanged pre-market. And then you take a look at the 10-year yield, Shonali, currently lower by about a basis point.
We'll talk a lot more about that bond market. I know it matters today going into that Fed meeting this week. But of course, some stocks to watch pre-market. Talking more about Boeing because it's down as Seattle employees walk out on strike for the first time since the great financial crisis. You have Boeing shares down almost 3% pre-market. We'll talk more about that. On the earnings front, Oracle impressed Wall Street with a bullish 2029 revenue target, while Adobe disappointed with guidance on AI investment returns. You have Adobe just sinking now more than 8.3% pre-market, and Oracle up more than 6.3%, Katie.
A good reminder, of course, that we are still in earnings season, but let's go back to the bond market and why it matters today, because, of course, bets on a 50 basis point cut next week are building again. You have Bill Dudley, of course, coming out, making the case for 50. You also have Neil Dutta over at Renaissance Macro pounding the table in a note this morning. And let's just be honest here, the elephant in the room, Nick Timrose over at the Wall Street Journal, out with an article, of course, exploring the case for a 50 basis point cut, which really reignited this current round of speculation.
He's defined himself as really the Fed whisperer this cycle, which is why traders are taking this report so seriously. And the question he poses at the very top is start small or begin big. And really, you're looking at a market on the razor's edge, Katie.
It is really interesting. Of course, Bill Dudley kind of exploring that as well, saying that right now, the risks to the labor market, those are more pressing than any concerns about lingering inflation here. So it's up to the Fed. I mean, less than a week to go. It's a big decision, and it's a live meeting.
And it sets a tone for the rest of the year. We're going to discuss this now with Ellen Hazen, FL Putnam Chief Market Strategist. And what would 50 basis points say to the market? There's a worry under the surface that 50 might be a little drastic here and set off this idea that things are worse than they seem. There's a flip side here that says if you start big, then it creates room to go less later on. How do you feel, Ellen?
That's the question of the day, Sonali, isn't it? And that's what everyone's talking about yesterday and today, especially after the Wall Street Journal piece that you referenced, as well as some other comments made by Mr. Dudley and others. So as we look at it, we think that a 50 basis point cut would be more problematic than a 25 basis point cut. And the reason for that is that, first of all, a 50 basis point cut does say, look, things are more serious than maybe you might know. And it does indicate a little bit more strong action, which might spook the market. But the other side, which I think is just as important, if not more so, is that a 50 basis point cut is very likely to boomerang on the Fed and to cause the equity markets to spike, thereby loosening financial conditions a lot more and maybe taking a little bit of that control out of the Fed's hands, which I don't think they want to do. So we think, like the market most of the time, that 25 basis points now, another 25 perhaps in November and December is the right move. And we think that 50 basis points not only sends a message that things might be worse than they seem, but also might complicate their job by sending the equity markets off to the moon again.
Oh, very fairly, Michael McKee points out that the Financial Times also has been pointing out the question about the razor's edge we're standing on as well. A little shout out to our former producer, Colby Smith over there. Ellen, you know, if you think about the spillover effect there is to the equity market from the bond market, is there a significant one that you expect, whether they go 25 or 50?
I think that the equity market is very focused on corporate earnings growth and what growth is going to be next year from a GDP perspective, what jobs are going to be, and what corporate earnings are going to be. And right now, that looks pretty healthy at 15%. I don't think that the equity market impact is going to end up spilling over to the bond market, which is much more focused on inflation and overall economic growth, but not so much corporate growth. So I think that those might be not as closely joined at the hip as they have been in recent months.
And Ellen, give us the outlook for small caps here. I mean, this has really been the back and forth, hot and cold trade of the past several months. I mean, if we enter into a cutting cycle where maybe the Fed is a little bit more aggressive than markets are pricing in right now, of course, taking that more cautious tone just to front load a little bit here, what would that mean for that universe?
It's been a really tough slog for anyone who's tried to invest in small caps over the last couple of years because there have been at least 4 pretty big false starts where in any given month, small cap universe has outperformed and then gone on to pretty dramatically underperform over the subsequent months. And the reason for that, as we see it, is that small cap earnings just are not there, right? So we all know about the debt and the fact that small cap companies have higher debt, more variable rate debt, they're more adversely affected. But the really important thing is that estimates for the small cap indexes just keep going down in a way that S&P 500 estimates are not going down. So you saw this false start again in July, right? And then where small caps outperformed, people thought, okay, now is the time. And then in August and in September to date, it's just been another disappointment. We don't think small caps durably outperform until after the economy has slowed and is exiting either a recession or a dramatic slowdown. We think in a soft landing scenario, when you have economic growth okay, that small caps are not going to do better than large caps. They just haven't gotten quite cheap enough, and you don't see that reacceleration that you really need in order for small caps to outperform.
All right, Ellen Hazen there, of course, with a dose of reality for the small cap trade there. Let's get specific here. Let's name some names and talk about some of your individual stocks. I see Booking Holdings on your list, for example, which I find interesting because so much of our conversations are centered around that slowing consumer, of course, that cost-conscious consumer, and yet here we are.
So we like Booking for a couple reasons. Number one, it's a pretty reasonable valuation for the growth that you're getting. And number two, regardless of the shorter term consumer slowdown, which I agree is happening, it's clear from the data that that's happening, you have this long-term secular trend toward experiences from goods and toward online from using travel agents. And so I think that Booking taps into both of those very well. You see estimates continuing to go up, and the company is very well positioned. I think that longer term, this is a winner. Shorter term, could you have softness because of a softening consumer? Yes, you could. but only if you're trying to trade day to day, week to week. I don't think that that's going to be a longer term problem.
Ellen, I also want to talk about D.R. Horton, because this is another play that is very firmly tied to the interest rate outlook here. And is 50 basis points, even if they get there next week, is that enough to set off the housing market significantly when you have such an overwhelming amount of mortgages really held still below 4%?
I think that the impetus and the catalyst for D.R. Horton is not necessarily a rate cut, because as you correctly point out, Sonali, the rate is not going to make that much difference on a 10 or 30-year fixed mortgage rate going forward if we cut by 25 or even 50 basis points. But there's a structural shortage of housing in this country, so there's this very long-term demand tailwind. In addition to that, D.R. Horton is focused on the growth areas of the country geographically in the Sun Belt region, which is where population keeps slowing. Every quarter we look at the numbers and population keeps flowing to those areas. So they have a secular demand driver from that front as well. And then finally, from a valuation perspective, you're paying a low double-digit multiple for earnings that are growing pretty strongly. So they're not levered the way many of the home builders were before the great financial crisis. They're at 0.2 or 0.3 times debt to EBITDA, so very safe balance sheet, pretty strong growth, and very reasonable valuation for what you're getting with these secular tailwinds. I don't think you should buy it with the idea that a 50 basis point cut is necessary in order for the stock to do well.
And Ellen, before we let you go, of course, you take a look at the bond market right now. Usually we don't talk about it with 20 minutes to go until the market open here, but traders currently pricing in a 40% chance of a 50 basis point rate cut next week. I want to bring that in with your positioning, because right now, according to your notes, you're underweight fixed income, which stuck out to me. Of course, we are on the precipice of a Fed rate cutting cycle. How unusual is it for you to be basically underweight bonds right now at the start of such a cycle?
That's a great question. The reason we're underweight bonds is because of what else you can invest in. So if you're underweight bonds, it means you're overweight something else. And we're overweight cash and overweight equities, and we're overweight some alternatives. And despite the fact that we might be at the beginning of a rate cutting cycle, I mean, I think we are at the beginning of a rate cutting cycle, that still doesn't make bonds attractive enough to be overweight compared to what you can see in equities, compared to how much you can still make in cash, and compared to some of the opportunities available in alternatives, and particularly in some of those increasingly democratized alternative private investments that investors can access in a way that they didn't be able to used to access 5 years ago.
All right, Ellen, really great to speak with you on this Friday morning. Our thanks to FL Putnam, Chief Market Strategist Ellen Hazen. Meanwhile, let's get a check on futures right now, because again, trying to make it 5. We've seen 4 straight days of gains for the S&P 500 so far this week, following 4 straight days of losses last week. Right now, the odds are in your favor. The S&P 500 currently up about 0.2% pre-market. Of course, a lot can change between now and 4 p.m. Meanwhile, you see the NASDAQ 100 currently flat on the day. Not that enthusiasm in big tech. Of course, we've seen little hints of it over the past 4 days, not so much right now. Let's get to some specific stocks, though, because we do have some breaking news, and that is that Waymo is going to offer Austin and Atlanta rides only on Uber next year. That has been a boon for Uber shares right now. You can see currently up about 5.6% pre-market. We're going to continue to follow that story and others. And to that point, let's get a look at the stocks moving ahead of the opening bell right now. We'll do that with Abigail Doolittle.
Well, Katie, it's super interesting because we do have the shares of RH surging. They're up about 20%. This, of course, is the company formerly known as Restoration Hardware, that high-end furnishing retailer. Again, up 20% on a very good quarter. They beat estimates. Sales rose 3.6%. They also provided a positive update on the future. They're saying that the healthy demand that started in the first quarter, that just showed up in the second quarter, it's likely to extend. Now, it is worth noting that there's a roughly 13% bearish short interest, so some of this could be a squeeze, but Citi is saying it's a solid step of progress. Turning to a stock that's down but well off its pre-market lows, Flutter right now down about 0.5%, Flutter Entertainment. This, of course, is the mobile and online gambling services company. They've announced a 56% stake in Brazil's NSX. That's worth $350 million. Initially, it's expected to weigh on earnings despite bringing in more users. This may maybe why investors are a little bit pessimistic. And then finally, Moderna down for another day. Yesterday falling 12% after they cut their R&D budget. They also are trimming their pipeline, having a rough time after less demand for that COVID-19 vaccine. This stock down more than 80% from its pandemic peak. Well, today, there's a slew of downgrades. Some analysts apparently think that maybe there's further downside. Oppenheimer, JP Morgan, Jefferies, Leerink, and there's more, down 5.6% in the pre-market.
Abigail, we thank you so very much for keeping an eye on all of it for us. Now, coming up, we're going to switch and talk about Boeing because factory workers go on strike for the first time since 2008. We're going to discuss the implications for the economy and the travel industry. This is Bloomberg.
So a number of people, I think from Homeland Security and or the CIA or NSA, have gone to Capitol Hill and said that TikTok is a danger to our national security. But the public hasn't been given that much detailed information about what the threat is. How much of a threat to our national security is TikTok?
The People's Republic of China acts adversely to the interests of the United States in different ways. One of those ways is through the dissemination of disinformation, the intentional communication of false statements, and TikTok is an extraordinary avenue through which to disseminate disinformation to millions and millions of people.
And now to high interest, a look at what's making headlines around the world. China will raise the retirement age for the first time since 1978. The move could stem a decline in the labor force, but it risks angering workers who are already wrestling with a slowing economy. Under the rules, men will retire 3 years later at 63, while women retire 5 years later at 55. Hindenburg Research is taking another swing at the Adani Group. The short seller said in a post on X that Swiss authorities had frozen more than $310 million as part of a years-long probe into the Indian conglomerate for money laundering. The Adani Group denied what it called baseless allegations. And Roaring Kitty is meowing again. A post about Petco on the subreddit dedicated to the retail trading icon Keith Gill has helped boost the company, which has posted encouraging results earlier this week. Gill didn't actually mention the stock on his own Reddit, YouTube, or X pages, and there's no evidence that he owns a stake in the company, Katie.
All right, meme stocks, they never die. But let's switch gears here. Let's talk about Boeing, because you take a look at shares right now. The struggling plane maker now dealing with a walkout in its Seattle hub, where a union representing 33,000 workers overwhelmingly rejected a contract offer. Let's discuss now with Sid Phillip. He is Bloomberg's deputy editor for global aviation, usually based in London, joining us on set. It's great to see you.
Yeah, likewise. Thank you for having me here.
It's good that you're here because, boy, it just feels like the hits keep on coming for Boeing. We'll get into the TikTok of what exactly happened with this deal, how it fell apart, but just put this into context for how bad this is for Boeing at a very critical juncture.
It's a crucial juncture for Boeing because, I mean, at the moment they've had curtailed production of their 737 MAX jet, which is the sort of workhorse jet for them. Essentially, they haven't been able to make enough planes. They've been, sort of the FAA said that they are sort of restricted to making 38 after the whole mid-air blowout that they had in January. And so Boeing's been sort of in sort of the ringer at the moment. They've had a management change with a new CEO. They've had a new chairman. They've had sort of a management reshuffle. And essentially for Boeing, they really need to get planes back out of the door because at the moment, there's no way for them to actually sort of start generating cash, which is vital. I mean, they have a $45 billion pile of debt that they need to get through.
So talk about this week alone, because the new CEO, Kelly Ortberg, seemed to have some wins in his discussion with labor. You fast forward just a couple of days, and a lot of those wins seem to have been reversed. Is this an about turn? How difficult does this make his job?
It does make his job really difficult because for Boeing, they really need, like, Ortberg's entire priority is to get their production back on track and get sort of planes out of the door so that they can sort of start generating cash and start working on their debt pile. And this is a setback towards that goal. And for the workers, I mean, the union did agree to a deal where the workers would have got 25% over 4 years, but the workers were expecting more, and essentially they've been asking for increased pensions, return to pensions, they've asked for increased healthcare, and they've asked for better pay. They've asked for 40%. So there is a sort of urgency to it, and the union and Boeing have said that they are working towards a deal, but it remains to be seen.
Yeah, 25%, certainly not nothing, but it's certainly not 40%. Still, it's striking just how overwhelmingly this was rejected. You take a look, union workers voted 96% to support a strike. I mean, talk to us about how much distance is between these two sides. What is it going to take to bring them back together, essentially?
It's going to take a deal that the workers are so on board with, and I think the workers are pretty angry at the moment in terms of what they've actually been given, and they're looking at how they can actually get what they've asked for. And the workers are in a really strong position at the moment because Boeing, because of all its various issues with production, is desperate to get a deal so that they can actually get this in. So for them, it's a really good position to be in.
Talk through the potential economic implications for Boeing here, because if the workers are on strike, obviously they're not sitting making planes and other things that Boeing needs them to do as well. Do we have a sense of how long they may strike for and what it could mean for Boeing ultimately?
So the analysts have said it could essentially, if it's 50 days, which was what happened in 2008 and previously, that would cost about 3 to 3.5 billion in terms of the impact on Boeing's cash flow. So it is a significant impact, and essentially every day that Boeing's not building the 737 and the 777 and the 767 freighter, it is a sort of that many days for that they can't actually produce planes and actually deliver those planes, which is when they actually get paid. And so for Boeing, they need to get those planes out of the door and actually start generating cash again.
Yeah, and I mean, to that point, they need to start generating cash again. How much can they actually afford when it comes to the price tag it's going to take to sort of reset labor relations onto the good path here?
I mean, that's the billion-dollar question. Essentially, what is Boeing willing to pay in order to make this problem go away and essentially get their production back on track?
Ultimately, when you think about the predicament they're in now, you were talking about this idea of them needing to get those planes out the door to get paid. What do their partners do in this scenario? Are more and more of them looking for other options?
In terms of, if you're talking about customers, I mean, customers have no options because the global industry is basically a duopoly, and Airbus is sold out of its best-selling A320 jet until the end of the decade. And so there's no option for a customer to actually do anything but actually just wait for their plane. And so they haven't actually got a solution.
Do consumers then feel that problem at the end of the day?
They will, because essentially they'll be flying around in older aircraft. There'll be older aircraft that are in service for much longer. And some airlines may not have as much capacity on offer as they would have had those planes been produced.
It's just a wild state of play, of course. That duopoly you describe, it's either Boeing or it's Airbus, and increasingly that just means you're flying on older planes. Sid, great to see you in person. That, of course, is Bloomberg's Sid Phillip. Now coming up, Uber's autonomous vehicle foothold just got a lot stronger. Details next in our Social Climbers. This is Bloomberg.
covers earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and
Countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a three.
As the economic picture
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Wednesday, the Fed decides.
I know we're all obsessed about what the Fed may or may not do on September 18th.
25.50, that doesn't matter so much.
We're being very measured where maybe other central banks aren't.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
We have made no decisions about future meetings, and that includes the September meeting.
At this point, the Fed is leaving it open.
It's going to be up to Chairman Powell.
Tune in to Bloomberg Surveillance, the Fed decides, starting at 1:30 p.m. Eastern.
All right, it's time now for Social Climbers. The company's making waves this morning. And first up, Uber announcing it will be the sole supplier of driverless rides with Waymo cars in Austin and Atlanta. This exclusive deal is a boost to Uber's ambitions in the autonomous vehicle arena. And you can see shares currently up almost 7% pre-market. Next up, we have Australia announcing it will fine internet platforms up to 5% of their global revenue for failing to prevent the spread of misinformation online. Now, this bill is part of a regulatory crackdown by the government where leaders are complaining that foreign tech platforms are too powerful. And finally, we have United Airlines announcing today that it plans to offer in-flight Wi-Fi from SpaceX's Starlink for free on its jetliners. It's the biggest in-flight internet deal yet for SpaceX, and it comes as airlines have been investing in faster in-flight Wi-Fi. You can follow all the latest company buzz on TREN Go on your Bloomberg terminal. Meanwhile, of course, a few minutes until markets open, you take a look at futures right now, currently up about 0.2% on the S&P 500. The NASDAQ 100, Sonali, still can't find its footing, down about 0.1% right now. And interestingly, small caps currently up about 1% pre-market.
And of course, we're less than 4 minutes away to that open as traders weigh the size of the Fed's next decision. Stick with us for the open. This is Bloomberg.
In this facility, which is part of your $2 billion investment in the last 2 years, it's a massive amount.
Yes, because, we focused a lot on automation and upgrading our quality standards so that we can adhere to the US FDA and European standards, because some of our vaccines now are going even to the West, which is a fundamental shift in our strategy, from back in the day when my father started the business, where we were predominantly in India and the developing
India-centric, now you're more global.
Yes.
So you're about 8,000 strong in this facility? All Indian nationals?
Mostly Indian, yes. I would say 99%. of talent that we've trained overseas and in India. We have our own internal skill building center where we train on site.
Serum started with just producing vaccine for tetanus, but it's producing a lot more vaccines now. What is the next big thing you think?
A global pandemic flu vaccine is something that we're working on, and I think the world will need that. Not only for the annual flu cases, but God forbid there's a flu pandemic. I think we are very well poised to make 1.5, 2 billion doses and roll it out very quickly to protect the world. And we have, of course, the other vaccines, as we talked about, HPV and malaria, that we've just launched, and we're going to scale that up as well.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now, weekdays only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
All right, we are moments away from trading, 23 seconds to be exact, on this Friday, the 13th. Welcome back to Bloomberg Open Interest. I'm Katie Greifeld. You can see we have some green when it comes to futures right now. Of course, as traders really debate what would be good news from the Fed last week. Of course, would a 50 basis point cut signal that they're worried about something, or would it signal that they're serious about supporting this economy? A lot of big questions hanging over the markets, of course, as we round out what has been a very good week following a brutal start to September. You can see the bells currently ringing right now at both the NASDAQ and the NASDAQ. The New York Stock Exchange, that is. Let's take a check on the major averages right now, about 17 seconds into trading, and it's pretty much as expected. You can see the S&P 500 currently up about 0.2% right now. The NASDAQ 100 can't really decide where to go. Big tech has been bouncing back and forth between gains and losses in the pre-market, currently a touch lower. But we have one clear winner, and that is your small caps. The Russell 2000 currently up to the tune of about 1.1%. We'll see how that one develops. But let's take a look under the hood right now, because we need to talk about Boeing. Under pressure after a union representing 33,000 employees rejected a contract, forcing the first strike since 2008. And Chanel, you take a look at the reaction in shares right now, currently down.
Red on the screen is never good, but at least it's less than it was before. Soaring on demand for luxury home products here, improving 18% higher as the market opens. This is despite cutting its sales forecast for the year. And some earnings movers. Oracle moving higher after reporting a promising long-term outlook. Wall Street was impressed by a bullish 2029 revenue target here, and you have the stock up more than 7.2% at the open. But on the other hand, Adobe down 9%. Sales guidance fell short of Wall Street estimates, raising concerns about whether its bets on AI are paying off. We're going to take a closer look now with Bloomberg's Abigail Doolittle.
And let's put those moves, Shanali, into the context of the week, because of course, Katie just mentioning that we're looking at a good week for stocks after a bad week last week, that rough start to September. And on today's fall, coming into today, Adobe had been set for a 4% gain, now down about 5% on that weaker than expected forecast, as you just mentioned, Shanali, having to do with less ability to monetize their AI tools. Oracle, on the other hand, now in the week, a banner week, up 22%, its best week going back to 2021. They, of course, had this investor update where they did raise their sales forecast essentially for 2026 to $66 billion. They also said that this trajectory should continue to 2029. That comes just after that strong report recently where they also announced another deal with AWS. So Oracle, one of the top software stocks on the year, up more than 50%. Let's dig into that Adobe pain, though, just a little bit more. These are the sequential growth numbers, or I should mention the year-over-year revenue numbers for Adobe. And you can see that we peaked back in fourth quarter, and now we've been moving sort of to the downside. This third quarter, an estimate here just slightly sequentially higher, but not overall, not a lot of great growth here. And when this is interesting to me for certain, Katie, if we take a look at this chart of the S&P 500, an ETF relative to the AI ETF, I would have thought, based on NVIDIA and Supermicrocomputer and some of these other AI chip companies, that the AI ETF would have blown the SPY out of the water, but that's not the case. The SPY up about 17%, the AI ETF right below. So maybe some of that Adobe weakness is factoring into this ETF.
Yeah, it's fascinating, too, to see when those lines broke apart. Of course, it seems like it was right around when we were sorting through all those big tech earnings, so clearly a sign of the times there. Abigail Doolittle, thank you so much. Let's broaden out this conversation now with Brooke May. She is managing partner of Evans May Wealth. She has an S&P 500 year-end price target of 5,600 to 5,800. And Brooke, we're right about at the lower end of that range. I want to talk about the Fed next week, though, and of course how that factors in, because I'll ask you the question that I've been asking everyone, and that's whether or not 50 basis points, whether that a cut of that magnitude next week, would that be good news at this juncture? What does sentiment look like?
I do think it would be good news. That said, I was surprised to hear Dudley come out and say that he felt a 50 basis point cut would be warranted. When we look at the totality of the data, it doesn't necessarily feel like we're in a dire situation where we need to expedite rate cuts. When you look at historically rate cutting cycles, the playbook isn't relevant. You know, typically we're cutting because we need to stimulate the economy, or there's an energy crisis, or there's a bubble that's burst. And so they have the ability to be cautious. They've been cautious all along. And Jerome Powell hasn't done anything to indicate that they're going to change their posture. So a 50 basis point cut would be welcome. However, it would surprise me.
Well, let's talk about why it would be welcome. I mean, is that because you think about sort of the effect of these higher interest rates, the fact that we're clearly in restrictive territory, or would it be good news basically because it signals that this is going to be a more aggressive Fed, that they're going to mightily bring down interest rates, which will ultimately maybe lead to that broadening out that we've been talking about beyond big tech?
I think that it's that, you know, we're just ready. We're ready to get back to neutral. And it doesn't need to be aggressive, but we need to show that we need to demonstrate that we're moving in that direction because it is restrictive. You know, when you look at small cap companies, for example, today they're rallying and, you know, they've been under pressure. They've been under a significant amount of pressure. When you look at small cap in general, only about 60% of those companies are profitable and they rely heavily on debt. And not all small cap companies are able to lock in fixed rate debt. So they're subject to variable rate debt, which is very expensive.
Today I'm going to talk about how to succeed with a startup. Obviously more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough. Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator. A really important thing to figuring this out is learning how to differentiate between real trends and fake trends. A real trend is something that's actually going to happen and a fake trend is not, or at least not yet. And before you make a big bet on a new platform, you want to make sure it's real. Now, there's an easy trick for this, which I'll share now. Real trends are ones where a new technology platform comes along and the early adopters use it obsessively and tell their friends how much they love it. A fake trend is one where people may buy the product, but don't use it, or at least not enough. So an example of a real trend, I already mentioned the iPhone, I'll mention that again. When the iPhone first came out, many people were dismissive because they only sold 1 million or 2 million that year. And they said, well, this just doesn't matter. But for the people that had an iPhone, they used it for hours every day. It became central to their lives. They loved it. They told their friends, you got to get one. And I think it was obvious then to people paying attention that something had fundamentally shifted. And we had a new computing platform that was going to spawn huge businesses. And it was a good time to bet on mobile apps. A fake trend, or at least a fake trend as of August 2018, I would say is VR. I do believe VR will be big someday, but today most people that I know that own a VR headset use it never or very rarely. And so although a lot of people talk about it, and maybe even a lot of people buy them, there's not the intense usage per user among the early adopters that I think you want to see before you make a big bet. Another thing that startups need, at least one evangelical founder, usually the CEO. Someone at the startup has got to be the person that is going to recruit, sell the product, talk to the press, raise money. And this requires someone who can infect with enthusiasm the whole world about what the company is trying to do. And someone who becomes the chief evangelist for the company, it's very hard to succeed wildly without that. It's very hard to build a team at all without being able to do that.
That's more robust than what we saw going into this year, closer to that 5,800 price target.
Brooke, happy Friday to you. That is Brooke May, Evans May, Wealth Managing Partner. We thank you for your time. Now, I want to bring you some breaking news because the Los Angeles Chargers and the Miami Dolphins are among NFL teams mulling private equity deals. Remember, the NFL opened up to the idea of private equity investment with team owners voting just about a couple weeks ago, really last month. They still need final approvals, but Bloomberg is now reporting that the Chargers is in advanced talks with 2 buyout firms already to offload a stake. And of course, the Dolphins also in talks with those private equity firms alongside potential individual buyers. These are 2 major markets. And of course, the deal making is on. Now, coming up, sticker shock in the grocery aisles. We're going to explore that with Tony Sarson, the CEO of Spartan Nash, a national food distribution and grocery retail chain. We'll get under the hood of what pricing looks like across the food aisle. This is Bloomberg.
Names in tech are on Bloomberg.
A large number of countries are subsidizing their regional data centers so that they could become able to build out their AI infrastructure. They recognize that their country's knowledge, their country's data, digital data, is also their natural resource. Not just the land they're sitting on, not just the air above them, but they realize now that their digital knowledge is part of their natural and national resource. And they ought to harvest that and process that and transform it into their national digital intelligence. And so this is what we call sovereign AI. You could imagine almost every single country in the world will eventually recognize this and build out their AI infrastructure.
Nobody covers technology like Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal?
Are markets too optimistic?
How do you worry about the things that are outside your control?
How does the current fighting completely stop?
I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Grocery prices aren't climbing as much as they had been in the last 2 years. And in fact, online grocery prices fell 3.7% last month, according to Adobe, the largest decline since the firm began tracking the numbers 10 years ago. Still, of course, many Americans are still frustrated by what it costs to put food on the table. Joining us now to talk about price of food is Tony Sarsam. He is the CEO of Spartan Nash, a food distributor and grocery retailer. Let's talk about the good, the bad, and the ugly here. Of course, inflation, particularly at the grocery store, is a hot button issue for Americans all over the country. Where are you seeing meaningfully get better?
Great. Well, thank you again, and thanks for having me back. I appreciate being here. Let me get a little backdrop on Spartan Nash before we get started to set the table a little bit. We are a food solutions company. We are in the wholesale business and the retail business. So we provide groceries and consulting services to about 2,300 grocery stores, including the ones that we operate ourselves. We are a proud provider of groceries to the U.S. military system worldwide, and so that gives our men and women in uniform a little taste of home wherever they may be stationed. And we have 17,000 associates that help us deliver the ingredients for a better life every single day. So that perspective of both the wholesale side and the retail side gives us some great insights as we see what's coming up and what's going on in the near future. So hot topic, obviously, about pricing. One of the interesting things is that there's an idea that food prices have driven a lot of the inflation in the last couple of years, and it's not really supported very well by the actual facts. So you guys saw the CPI data here recently. Inflation is moderated down to 2.5%, and food prices are down to 0.9%, and they've actually trailed overall inflation for most of the last 2 years. But people are still very concerned. They're very concerned about trying to make the ends meet overall, and they focus on grocery bills. As a matter of fact, about 79% of the folks that we've talked to in our own internal survey say that pricing of groceries is the most important thing for them, and we take that very seriously. And so we think about how we construct the overall offering to our shoppers. We want to make sure they have access to value and actually the other things that they want that they're most important to them.
Well, appreciate that context. And it's a good point. You think about the most recent CPI reading, it was shelter costs that drove a lot of that inflation. So there's a new, of course, boogeyman out there. But I want to talk about categories, because you look at overall food costs and they barely rose last month. But then you take a look at an index for meats, poultry, fish, eggs. It rose 0.8% in August. So how much dispersion are you seeing when it comes to different categories of food?
There is dispersion always, and the ones you just mentioned are interesting because they're close to agriculture commodities, and so you see these effects of things like macro effects like weather, like a bird flu, which is actually causing the egg prices to go up right now. You see things like the overall tough weather that was in West Africa driving up cocoa prices pretty dramatically. So staples in my cabinet pantry at home like Nutella and Cocoa Puffs and those kinds of things, those are all experiencing some cost increases because of those effects. But those items like the meat and eggs and cocoa, those prices will go up and they'll come down when the event that caused them stabilize and more episodic. And there are some other more longer term effects in the grocery categories as well, grocery aisle as well. those long-term, when you think about overall, Americans spend about 11% of their income on food. It's about the same numbers it was 10 years ago, but prices have gone up over that time frame, and there's some lurking price increases that are sort of interesting and think about how these things get caused. Things like, in the last few years, we're paying about 50% more for tractors and trailers, the big rig trucks that get the products from the fields or from our DCs into our stores. The freezer cases in our stores are about 35%.
You know, it's interesting to see where there's still that lingering inflation. I want to pull up a chart here just of cocoa prices, for example, because to the point that you're making, they go up, they go down, and they have come down from their peak, but they are still meaningfully higher than where we were a year ago. It's hard to see how, you know, cocoa's, people like chocolate, cocoa's a staple, right? Is that fair to say? When you see prices at this kind of elevated level here, what is that ripple effect? Who has this crowded out?
Yeah, so the cocoa being a staple is absolutely the right thing to say. It's a critically important item in everyone's diet. So that agriculture community, particularly the one where most of it comes from West Africa, is not fully recovered yet. So that's where you see the continued higher prices there, as they are kind of recovering from a lot of issues driven by the early weather events, but some other events around farming there. So I think there's going to be a while before we get all the way out of that one.
Right, and it's a good reminder, like you said, I mean, there's so many factors you can't control when it comes to bird flu, extreme weather, et cetera. But we're talking about food prices, and food prices, of course, have become a political issue as well. You think about the conversation happening right now around price gouging at the grocery store. Have you seen any evidence of that?
I have seen no evidence of that. And as a matter of fact, you think about this industry broadly, we are about a 1.6% profit collectively. So that's the most recent data about the overall profitability in our industry. So it's very, very competitive, very low margins. And so we are always, all of us and our competitors are fighting to get shoppers dollars and offer them something that makes our stores attractive to come in and spend their hard-earned dollars. I mentioned a moment ago that 79% of them are looking for good deals. So that doesn't really match up so much with taking extraordinary prices, because you're going to be less competitive in that space. So I think that element is actually a self-governing element. This is such a competitive industry that you're going to always have people fighting for the shoppers' scarce dollars, and so it kind of regulates that overall pricing effects. But there are people who feel those effects that I mentioned a moment ago. There are prices that are passed on to customers because things like the tractors and the freezer cases and even the bags that are up 30% over the last couple of years. And there's one lurking variable I think that's sort of interesting, and that's swipe fees for credit cards. So that's also part of the overall cost, but it's late in the value chain, obviously. It was right at the end. And those fees for us, we've seen a 34% increase in the overall cost in our stores. And while the fee maybe seems small, it's between 2 and 4% typically, those industries are not quite as competitive. There's two companies that control 80% share. There's 21,000 independent grocers who compete with each other for that 1.6%. The two credit card companies have a little over 50% margin. So the interesting stat here is that if you bought $60 of groceries in the store, the store would get about $1 of profit, and the swipe on that would get $1 of profit for the credit company as well. So we're looking at ways we can better regulate that. There's some legislation right now in Congress that may address that. That's a way the government can actually help out.
Tony, we have to leave it there. Hope to have you back soon. It's great to see you in person.
Wonderful to be here.
That, of course, is Tony Sarsam. He is the CEO of Spartan Nash. Now, coming up, meet the dirtbag of the internet, who happens to be behind the crypto project promoted by Donald Trump. That's next in our Wall Street Beat. This is Bloomberg.
Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching The Close. Welcome to Balance of Power.
This is Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
And it's time now for the Wall Street Beat. In the last year, Donald Trump has fashioned himself into a friend of the crypto crowd. He and his two older sons have been particularly good friends to World Liberty Financial, a crypto project that they've been promoting on social media. To tell us more behind the man behind that project is Bloomberg's Zeke Fox. And it's fascinating because this is somebody, Zeke, that wasn't very well known to the rest of the crypto industry, was he?
Yeah, I mean, his name's Chase Hero, and he was a weed dealer. He sold weight loss colon cleanses, $149 a month get rich quick class. And now he's the guy behind World Liberty Financial, which is a new crypto venture that the Trumps are promoting like just ahead of the election.
Yeah, it's wild. I mean, former President Donald Trump himself has teased in a video that he'd announced details on September 16th. It's September 13th right now, Friday the 13th. What are we expecting to hear? I mean, how intense is this involvement?
Yeah, so I'm told that Hero is the kind of main deal maker behind this. He met the Trumps through a real estate developer who's a longtime friend of Trump. And you said dirtbag of the internet. That's what this guy called himself on a video. I can't even read you most of the other quotes, but he's got like a very cynical attitude towards crypto, and nobody in the crypto industry that I talked to has heard of him. There's a lot of skepticism about this World Liberty Project, even among crypto people who maybe aren't known for having the highest standards for how well thought out projects need to be.
You can certainly go to the story and read it. It is one of the most read ones on the Bloomberg terminal on Bloomberg.com. Some of those expletives are certainly in there. Zeke, why is this the project that Trump is touting when so few people in the crypto industry are really familiar with it?
I mean, that's the question that a lot of people in crypto are asking. Trump used to criticize crypto. He called Bitcoin a scam. Then he went and spoke at the Bitcoin conference. He said he's going to make the U.S. the crypto capital of the world if he wins. But a lot of people in crypto are like, we like that, but why are you now starting your own for-profit crypto venture?
Right.
Like, why not? What does it have to do with crypto policy?
Yeah, a lot of big questions there, of course. It'll be interesting to see, of course, what Donald Trump unveils on September 16th. That is Bloomberg's Zeke Fox. Great reporting, as always. Of course, Zeke is author of the great book, Number Go Up. It's all about crypto. I suggest you go read it. Coming up in our next hour, though, we'll speak to Jay Hatfield and Jason Furman on the economy and next week's Fed meeting. Plus, we'll speak to the CEO of Pirelli about the tire manufacturer's new partnership with Bosch. All that and more coming up. This is Bloomberg.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors, including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, coming up, we drive this conversation forward of Bloomberg Intelligence. This is Bloomberg Intelligence. It is Friday morning. We are broadcasting live from our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. Alex Steele and Paul Sweeney. You missed data coming across a little bit better than expected. We're going to break that down with Joanne Su from the University of Michigan. That's coming up. George Ferguson, Bloomberg Intelligence Senior Aerospace Analyst. Talk to us about Boeing. Just when you think it can't get worse, boom, another piece of news comes out against Boeing, this time a strike. We're going to break it down with George Ferguson. Mo Hagman, the head of solutions and multi-asset strategies at Invesco, is going to discuss his outlook for these markets. So we're going to break down the markets. We're going to break down some of this economic data coming out. We're going to do that over the next 2 hours. Alex Steele, Paul Sweeney. Right now, let's kick everything off with Miss Lisa Mateo.
You got it. And we've got Market Drivers brought to you by IBKR with Interactive Brokers Forecast Trader. You can trade your views on key economic and climate indicators. Visit ibkr.com/forecast and get started today. All right, we have stocks on the move after wins across averages of more than 0.5% to 1%. Now, this comes after a pretty mixed bag of U.S. data this week. It's really been keeping investors guessing on the size of expected rate cut from the Fed next week. This morning, we learned import prices fell in August. Oil prices declined. Imported airfares saw seasonal declines, and now we have the reader sentiment coming in from the University of Michigan. The survey was for 68.5, comes in at 69. The prior was for 67.9. Let's get the reaction. So we have the NASDAQ up 0.2%, 50 points at 17,620. We have the Dow up 0.5%, 212 points at 41,308, and the S&P 500 up 0.3%, 18 points at 5,614. The 2-year yield 3.57%. That's down 6 basis points points. The yield on the 10-year 3.66%, and that's down about 1 basis point. We have shares of Boeing. They're down about 2%. Its factory workers started their first walkout 16 years. TD Cowen estimates the strike could last 50 days, cut up to $3.5 billion from Boeing's cash flow. Meanwhile, you have American Airlines flight attendants. They approved a contract. It's going to raise wages as much as 20%, increase pay benefits by $4.2 billion over 5 years. American Airlines up about 1%. And we'll stick with airlines. Some news from United. It selected Elon Musk's Starlink service for in-flight internet. We have United up nearly 1%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That's a Bloomberg Business Flash. Paul and Alex.
All right, thanks so much, Lisa Mateo. Happy Friday, guys. We made it.
We made it. There we go.
And just to clarify,
it's Friday. I'm in the office.
You're in the office.
Okay, good.
It's just for Paul to clarify.
It's Friday the 13th.
It is.
Oh,
maybe you shouldn't be in the office.
Yeah, maybe I should.
And just to clarify here, sure, the 1 terabyte thing for the phone is expensive, but it's $50 a month. Now, I bet if you add up all the apps you have on streaming for video, that's way more than $50 a month. So, when you look at it from that perspective.
Well, Anurag Rana from Bloomberg Intelligence just texted me his order. So
good.
Show me exactly what he got, so I know what I'm supposed to get. He's my personal shopper.
Okay, and teal is still a no-go.
No, I think he got the black titanium. That might be
okay.
That might be like James Bondish kind of thing.
Sure, we'll go with that. All right. Happy Friday, everybody. Alex Steele and Paul Sweeney here for Bloomberg Intelligence Radio. Let's get more on UMich. So it was really that 1-year inflation expectation falling to 2.7%, the lowest since December 2020. Joanne Shu is University of Michigan Surveys of Consumer Director, and she joins us now. Walk us through the increase in sentiment and the decline in those 1-year inflation expectations.
Consumers actually now have had several months of general improvements in how they feel about the economy. Clearly the drop in 1-year inflation expectations is a huge part of it. Consumers are 100% aware and have noticed that inflation has slowed down quite a bit, not just this year, but over the course of the last 2 years. And consumers are starting to feel a bit more optimistic about the future. With 1-year business conditions, we've had 4 or 5 consecutive months of increases at this point. I think they are recovering a bit from the malaise that we were seeing earlier in the summer.
So the headline, Joanne, came in at UMich sentiment 69 versus consensus of 68.5 and 67.9 last period. Can you frame that? Give us a sense of context there. Like, for example, for ISM, above 50s means the economy is expanding, below 50 means it's contracting. What does a number of 69 mean to you? Put that in context for us, please.
So overall, it's still below the historical average that we've seen since 1978. But I think what's more important than just the number itself is the overall trend. And now we've had 2 consecutive months of increases in sentiment. We're at the highest level since in several months now. And so, I think the thing to note is that consumers are starting to feel a bit more upbeat, and that's the upward trend that we've been seeing.
How does it go on party lines, Republican versus Democrat? Because is this the first survey that really encapsulates Biden out, Harris in?
Yeah, we saw a bit of that at with the August reading, and we saw kind of a continuation of that. So it's very clear that Democrats are seeing, both Democrats and Republicans are now increasingly expecting a Harris win, relative to last month and certainly relative to when it was Biden versus Trump. Now, Democrats think that's a good thing, and we see that in their economic expectations. It really surged in August, and we were continuing to see, this higher level in September as well. Republicans, on the other hand, think that the potential of a Harris presidency is bad news, and their sentiment, their expectations have declined. And so we saw a widening of the normal partisan gap in August, with Democrats improving, but that was offset by Republicans getting worse. And we saw a little bit more of that, not as dramatic as last month, but that partisan gap is continuing to widen.
All right, thanks so much. Really appreciate it, Joanne. Joanne Shu, University of Michigan Surveys of Consumers Director, joining us there on UMich, slowly grinding its way higher, and at that 1-year inflation expectation falling as well. All right, let's get more on the markets. Vincent Signorella joins us now, Bloomberg macro strategist, joins us. All right, what you watching?
Well, actually a very good report from University of Michigan. Just want to echo the sentiments there. Gas prices, mortgage rates falling. The expectation is the consumer will remain confident, but have to see how services inflation is going to play in down the road. As you mentioned, we've got a big increase with American Airlines flight attendants contract, and now we've got a Boeing strike with that stock trading lower today. You know Boeing's going to come around at the end of the day and probably offer big raises to their workers to stay in Seattle, which was key to have the building of the next airliner in Seattle. All of that is going to add to services inflation down the road. So while inflation is being patient now and moderating, it's still nowhere near the Fed's inflation target, which certainly brings us up to the meeting of next week, where traders are now pricing in more or less 40 basis points of rate cuts for next Wednesday, which isn't obviously going to happen. It's either going to be 25 or 50. My book basically is going to say 25, but the expectations were heightened yesterday after some reports from some former Fed governors saying that the Fed, in all likelihood, could go 50 next week.
So, looking, Vince, just, yields coming in yet again, the 2-year down another 5 basis points, a 3.58. I mean, we were just at 5% a cup of coffee ago, as Tom Keene would say. When you talk to traders here, is the market ahead of itself a little bit here? Or are they just kind of pricing in where they think the Fed's going?
No, I think they do feel the market is a little bit ahead of itself, especially the equity market. The Treasury market's a little bit more realistic about things, I think. You have to take everything with a grain of salt. The market jumped very, very much yesterday following a Wall Street Journal story citing 3, and I'm going to say this very loudly, former Fed representatives saying that they thought the Fed could go 50 basis points. I mean, it's all well and good, but none of them have been particularly accurate over the years. So I'd be a little hard pressed to put my money where their mouth is, to be frank. And I think going into an election, I just don't find it realistic that the Fed would want to cut 50 basis points to put it out there. The criticism that they would be getting, most likely, obviously, from Trump and the Republican Party, isn't worth waiting 2 more months or even cutting in October if they thought there need be. They don't have to cut at a meeting. They can go anytime they want to. As Paul Volcker, with his Saturday Night Special, showed us back in the 80s. It to me is just unrealistic. I think markets are ahead of themselves, yes.
All right, Vince, thanks so much for joining us. Vince Signorello, Bloomberg macro strategist, joining us from the Primo office location, which he has absolutely just made into a complete office there. So we are so proud of him.
Which is otherwise known as his basement.
Oh, okay.
Yeah.
Okay, very good. There you go. All right, let's go to our friends at Boeing here. I mean, stock down 2.7%. They got a strike up there in that Pacific Northwest region of the world, which is where they are generally based. I think the heart and soul is certainly there. George Ferguson joins us. He's a Bloomberg Intelligence senior aerospace analyst for Bloomberg Intelligence. George, how is it? So we've got a strike affecting Boeing up there in the Seattle area. How impactful is this strike to them? What do they need to do?
Yeah, so it's super impactful, right? Because it's on their 737 MAX. I mean, it's going to be on the programs that are out of the Pacific Northwest, I should say. First, which are going to be 767, 777, and the 737 MAX. The 737 MAX is what matters most, right? That's the revenue generator. That's the cash flow generator. That's part of. No, that's not even part of. That's the largest part of their recovery plan for the back half. So super important. Look, we'll see how long the strike lasts, but if they can't get 737s delivered, this back half recovery is in bad shape.
So let me get this straight. You were in the city yesterday. Then there was this huge Bloomberg Intelligence celebrating 15-year party where you all are like struggling to focus, and then somehow you wind up back at home this morning. What is this?
It's been a busy 24 hours. I wish they could have timed the strike differently, but
I definitely thought he'd be showing up very tired, but in the studio. All right, what's the TikTok now? So what's the schedule of events?
Well, I mean, I think, Boeing and the machinists have to get back together at the table and figure out what the machinists want so they can get them back on the job and start delivering airplanes and generating cash, right? The machinists sounded like they were a little bit coy about it, too. I heard one of them saying, you know what, as soon as we have a chance, we'll get back together to talk about it or something like that. So sounds like they think they've got a bit of the upper hand, which I think they do. I think, Boeing probably has to go back and look in their pockets and figure out how much more of a pay increase they can give, right? The Spirit Aerosystems folks got a mid-30s pay increase. So I suspect the machinists are looking at that thinking, hey, we probably deserve something close to that. And I think that they want some better guarantees on an airplane. They want to be guaranteed. I think that the next generation 737 is the most important airplane for Boeing. So if the Machinist Union has sort of longevity in their sights, they want to be building that 737 successor. And they don't want just the commitment to be able to build it to last for the 4 years of this contract, but they want it to last longer, if not forever.
And George, just refresh our memory. Where does Boeing actually make their planes? I know they do it up in Seattle, but do they do it in maybe some areas of the country that are not unionized?
Well, so they do make the 787 in South Carolina, down by Charleston, and that's a non-union plant. So I expect that 787 production will continue. Everything else is made up in the Pacific Northwest from a commercial airplane standpoint. And so 767s, 777s, they're made in Everett, Washington, north of Seattle. And the 737 is made, is final assembled at a single plant in Renton, Washington, which is kind of southeast of Seattle. Those are all union shops. I expect them all to be doing little to no work today. And then, of course, the fuselage comes out of Wichita, which is owned by Spirit Aerosystems, which Boeing is buying, Wichita, Kansas. But again, they had a strike earlier this year, got mid-30s pay increase, and they should be continuing to work for a while.
So I guess then the question becomes, how long? Now, I know we talked about that yesterday, and you're like, look, it can't go on more than like 2 weeks. One analyst was mentioning 50 days was what they were kind of looking at, which is a significant cash burn for Boeing. What's your best guess?
Yeah, I mean, I think there's a lot of people out there saying 50 days because that's the average strike, blah, blah, blah. I just don't, I don't subscribe to that being the right logic here. I'm saying a couple of weeks because I think Boeing really needs these workers back on the job. There is no substitute for these workers, period. And so I think they're got to go engage the union intently and figure out what it's going to take to put them back, back on the job. I mean, we think, look, our analysis was that it would cost an extra $1 billion a year or something like that for wages, right around there at the 25% increase. That would probably trim Boeing commercial margins 170, 200 basis points. Do you like that? No, but it's not the end of the world. Right? Back pre-pandemic, this was a company that was making 13%-ish margins in that business, 10 to 13. So can you bear that and be profitable? You can. Can you bear more? You can. So I think that means that Boeing has the leeway. They got to get to building airplanes in volume again. So they got to engage the union and get it done. That's why I'm saying I think less than a couple of weeks. I think they got to get it done.
Hey, George, I mean, I know in the past you talked to us about, the labor shortages in the aerospace industry. Where are we where is the industry in terms of getting past that? Is that still a challenge, getting good folks in the factory floors?
I think it's totally still a challenge, right? And so we saw a pretty decent turnover in the aerospace workers, coming out of the pandemic. I think some of them watched their industry looked like the collapse, right? Air travel went to zero for a couple of quarters or almost zero. So, demand for airplanes, people looked at it and thought, hey, the industry I'm in is horrible. And if you were, I think, near retirement age, you said, let's cash it in and move to Jacksonville, Florida or something like that, right? So it's hard to get those folks back to the line from Jacksonville. And the backfill, part of the backfill challenge is the backfill came out of some of their suppliers. So they kind of hurt their own ecosystem as they pulled some of the backfill in, and they're in the middle of training that. We even heard CEO Calhoun say, the old CEO Calhoun say, I think at one of his congressional testimonies, he talked about people coming in the door having experience bending metal and, working with their hands. And I think, he said something like in the old days, and this isn't exactly right, but it's close, maybe 75% of the people that came to the door had experience working with their hands, metalworking. Now 25%. So they're in the middle of trying to train that next generation of aerospace workers, and the supply chain is still trying to backfill. I think it's been getting better.
Yeah.
But that training and backfill is still going on.
All right. Hey, George, we appreciate it. George Ferguson, Bloomberg Intelligence, Senior Aerospace, Defense, and Airlines Analyst. Great stuff. Good to see you there. Coming up, Mo Hagbin is Head of Solutions and Multi-Asset Strategies. He'll be joining us from Invesco to discuss the outlook for the markets. Yep, we know the Fed's meeting next week. Does it matter if it's 25 or 50, or is it the long-term trajectory? We'll break all that down for you. Happy Friday.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
In the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. The world's biggest bond market revived through thoughts of a half-point rate cut by the Fed next week, and that really caused a slide in Treasury yields, gains in stocks. Swap traders currently pricing a 40% chance of a 50 basis point reduction. So let's get to the numbers. We have the 2-year yield at 3.59%, down 4 basis points. The yield on the 10-year 3.67%. That is little change. I'll take you to the 30-year 3.99%, and that is little changed. We head over to the Nasdaq, up 0.5%, 91 points, 17,662. We have the Dow up 0.6%, 254 points, 41,351. The S&P 500 up 0.5%, 28 points, 5,623. Want to point out commodities. We'll head over to spot gold, higher, $2,577 an ounce. We have Brent crude, $73 a barrel. WTI crude, $70 a barrel. Adobe, shares of Adobe, they are down about 8%. Its revenue forecasts failed to reflect that AI uplift. Meanwhile, Oracle shares up 2%. Investors cheered the long-term sales targets. And then stocks on the move, that's furniture retailer Restoration Hardware up 20%. Demand picked up last quarter, lifting revenues, adjusted earnings above estimates. And then Moderna, their shares down nearly 5%. That follows yesterday's sell-off. They released this cost-cutting plan that really failed to reassure investors. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That's a Bloomberg Business Flash. Over now.
Thanks so much, Lisa. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business and finance, economics through the lens of our Bloomberg Intelligence folks. They cover 2,000 companies and 130 industries worldwide. They're a little tired today. They had a 15-year anniversary party yesterday, so, you know.
Yeah, we cut it loose a little bit.
Yeah. I mean, Paul got some sleep, but the other guys, I'm not sure. All right, but we want to go outside of Bloomberg Intelligence now for a look at how to market is positioned into the Fed. Mo Hagbin is head of solutions and multi-asset strategies over at Invesco, and he joins us now. What is the setup like in terms of asset allocation headed into Wednesday?
Well, Alex, thanks for having me. Nice to be here with you and Paul. I think, we are continuing to maintain a bit of a defensive posture, and we have been defensive for about a couple of months now. And really, this is around what we're seeing in economic growth expectations, both from the market and from the data. We are very benchmark aware, so I think that underweight isn't something that's significant at this point, just given how the economy has been incredibly resilient and the market has been incredibly resilient. But what we're seeing in the labor market and what we're seeing with economic growth over the last several quarters is something that we're watching very closely.
Mo, and how about being defensive? What does that mean, fixed income versus equities here?
Yeah, so that means we have a little bit of a longer duration profile versus our benchmark. So we're, favoring fixed income over equities. So, and within equities, there's a bit of a tilt towards more defensive sectors. So think healthcare, consumer staples, information technology. These are the areas that are a bit more defensive. These are companies that are higher quality and lower volatility, generally cash flow rich, and can weather an economic downturn or a slowdown in growth.
So does that mean that you think that the bond market, if we look at the equity and the bond market as being on different pages, in that we're making like another run in the S&P here versus the bond bull appears to be very sticky, does that mean that the economic situation is geared more towards a recession than a soft landing in your view?
I don't think so. I think we're still probably base case soft landing. But, what we're thinking about is just in the shorter term period. So from a tactical perspective, just given how far extended the equity markets are, and in our opinion, yields are very attractive at these levels. They have been, although they've come back a little bit. We're kind of extending that duration profile, getting underweight equities slightly relative to our benchmarks. And again, this is all around growth and growth expectations, although we don't necessarily see a recession in the next couple of quarters.
So, Mo, how about on the fixed income side? Are we sitting here in 2-year treasuries at 3.6%, or are we going out there and taking some credit risk? What are we doing there in fixed income?
So in credit, we favor, again, higher quality credit. So, credit spreads continue to be incredibly tight. Relative to equities, I think credit is a very attractive risk-adjusted allocation. But we're probably not right now favoring kind of the lower quality, high yield sectors, and we're taking a bit more of a defensive posture.
That's where the best performance this year in fixed income has been, and by far has been, in U.S. corporate high yield.
Exactly, and I think that's part of the reason that we've gotten a bit defensive. So just to kind of backtrack a little bit, we have been pretty risk on in portfolios for the last several years. Post-COVID, we took a little bit more of an aggressive stance versus our benchmarks. We kind of maintained that stance over the last several years. And now what we're seeing is just that softening of the economic data. We're seeing some softening in the labor markets, and that's kind of what's informing a bit of a defensive posture. But I don't really want to overdo that, right? You know, we're not kind of underweight equities to a significant magnitude. We're not suggesting that people move into cash. It's actually quite the opposite. We're telling investors and clients to get out of cash. We've seen elevated cash balances now for a long time, and the yields on offer, if you extend that duration, seem to be very attractive to us, especially as we're moving into an easing cycle and those short-term rates are going to be coming down. Yeah, JP Morgan was saying that usually the rate cut cycle needs to get underway more significantly for then the money to move, but you're right. I mean, over $6 trillion ready to roll. Hey, I'm curious as to dollar yen. It has a pretty significant re-rating at this point. I think we're at 140, right? There was some reports on Bloomberg that we're seeing some bullish bets on the yen right now. What's your take on where that currency goes, and is the carry trade unwind situation over? So from a currency perspective, just kind of consistent with my comments earlier around equities and fixed income, we have a bit more of a defensive posture. So that means overweights in dollar, GBP, euro versus international currencies, you know, especially if you kind of think about the more emerging market currencies. You know, I think right now the defensive posture is probably warranted, just given we're kind of going into election season. September and October tend to be more volatile months for the market overall. And that home country bias, at least for us, is kind of an important factor as we get through the next few months.
In terms of the equity market, where's valuation for you guys? Do you feel like this market is fully valued at this point? How do you guys think about that?
I would say fully valued to maybe a little extended, just given what we've seen year to date. So for us, there's no real concerns around earnings or earnings projections. There has been some revisions that we're taking a close look at, but for now, I would say probably well priced or maybe a little bit extended relative to what we see kind of on offer in other places outside of the U.S. And I think my comments are very much on the U.S. side. And the equity market in the U.S. is pretty concentrated. That's another topic that we're having a lot of conversations on with clients. We expect to see that broadening if the economy continues to be resilient. But if we are going to go into a prolonged downturn or a growth kind of scare, actually the defensive sector should perform better. And I've talked about this a little bit on the show before. In the past, the relationship between equity sectors and rates was really when rates were going up, that was not necessarily a good thing for sectors that had more duration exposure or more interest rate sensitivity. So technology, healthcare, we've kind of seen the opposite of that. So, it's a little bit of a weird dynamic at the moment, but I do think that should re-normalize. So what the catalyst needs to be for small cap value stocks to really get going again, I think is, a little bit of a change in the regime and an economy that kind of re-accelerates, because those companies, small cap companies, value companies, they tend to have more operating leverage. They tend to be more geared to the business cycle. And I do think longer term that relationship will still hold. All right, Mo, thanks a lot. We really appreciate it. Thanks for stopping by. Mo Hagbin joining us there was his call on asset allocation. He's head of solutions and multi-asset strategies over at Invesco. So, of course, the question is, what does the Fed do at 2 p.m.? And it's one of those things where we talk it to death and then nothing actually happens that's really significant for the markets. We've already priced it in. So it brings us to the survey. And you got to have a nice survey, Bloomberg Economist, that we produce here that kind of shows us where positioning the thought process is. Katerina Sarayeva is Bloomberg Federal Reserve reporter, and she is standing by. What is the survey telling us now about what the Fed will do on Wednesday?
So the economists in the survey see a 25 basis point rate cut on Wednesday, which is kind of, that's been the widely expected move, although, it contrasts a little bit with the market pricing, especially today. We're seeing some more investors kind of jump into that 50 basis point rate cut camp. The survey sees 25 on Wednesday, and then that'll be followed by 2 more 25 basis point cuts at the other 2 meetings this year.
So how has this survey kind of maybe evolved over the last several times you guys have done it in terms of expectations for economists in terms of what the Fed will do and maybe how aggressive they'll be?
We're definitely seeing expectations of a more aggressive Fed, more rate cuts, a faster pace. So, rate cuts likely at every meeting than we saw earlier this year. I mean, things have really fluctuated quite a bit throughout the year. But if we compare it, for example, to the June survey, we've seen a lot more weakening in the labor market since then. So, of course, you have economists now thinking that we're going to get a bit more policy normalization from the Fed over the coming months.
What are individuals talking about in terms of further out? Like, okay, we get 25 now. Does that push that 50 to November and then push another 50 to December?
So in the survey, which is all economists, they do see just 25 basis point cuts this year at the 3 meetings. You definitely have some folks seeing a 50 in November or a 50 in December. That's definitely, within the responses, but it's just not the majority of folks. But, again, in the markets are pricing a 50 at some point this fall. So I do think it is still like in the realm of possibility, and you could definitely see that happening at the November meeting. I mean, that's also a great one because it's after the election, right? Mm-hmm. Right now we still have this kind of election situation going on.
How important is kind of the changes in the labor market impacting the Fed, do you think? Are you seeing that in your survey, the fact we've ticked up to 4.2, 4.3 unemployment?
Yeah, for sure. So there's 2 big things that the Fed, that Fed officials kind of put into their economic projections, which are released quarterly, and we'll get an update of that at this meeting next week. And that's how they're seeing the risks to inflation and the risks to employment. And so we asked economists, what they think about this. They're now much more concerned about the labor market and risks, to the upside on the unemployment rate than they are about inflation. That's a much more balanced picture right now. And you hear that from Fed officials too. I mean, they've said they're paying a lot more attention to the labor market now. We have seen some weakening, and inflation is, getting closer and closer to their 2% target. So they can start to look at that other side of their mandate more.
All right. Katerina, thank you so much. We appreciate it. I'm sure it's going to be an extremely busy week for you next week. Thank you for helping set us up. Katerina Sarajeva, a Bloomberg Federal Reserve reporter, joining us. My thing is, though, we're going to talk about this ad nauseum, but then at some point we're already priced. So, I mean, I guess this is the point. Jay Powell doesn't want to actually rock the market. No. I mean, again, you look at the 2-year Treasury off another 4 or 5 basis points today, 3.59%. We were at 5% just at the end of April. So a big move already in the short end of the market. Yep. You know what's not moving nicely? That's Adobe. That stock is getting hit off 9%. We're going to go to Dan Ives, Managing Director and Senior Equity Analyst at Wedbush.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
The Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Well, we've got the Dow leading the gains in Friday, trading right now up about 0.7%, 307 points. We have the S&P 500 up 0.5%, 28 points. The Nasdaq up 0.4%, or 82 points. The two-year yield, 3.59%. That's down 4 basis points. The yield on the 10-year, 3.66, and that's down 1 basis point. To currencies, we have the dollar weaker. Japanese yen stronger, up 0.7% at 140.71 against the dollar. Euro, British pound stronger. We have Bitcoin up a fraction at about 58,000. Few companies making news. That's Amazon plans to spend an additional $2.1 billion on its contract delivery unit. That includes things like raising pay to almost $22 an hour. Amazon shares up 0.3%. And 4,800 people working at Verizon, well, they took up the company's offer to walk away in exchange for a severance package. That will cost Verizon up to $1.9 billion. Verizon up about 0.5%. Cox Communications cutting hundreds of workers, about 5% of its staff. Revenue of its cable TV and phone service declines. And finally, Uber. It's been selected as the sole supplier of rides on Alphabet's Waymo cars in Austin, Atlanta. It's for Waymo's all-electric Jaguar I-Pace vehicles. Uber up 6%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That's a Bloomberg Business Flash. Calling out.
All right, thanks so much, Lisa Mateo. Alex Steele, alongside Paul Sweeney for Bloomberg Intelligence Radio. We're broadcasting to you live from Interactive Broker Studio right here in Midtown Manhattan. I saw that, though, for the Waymo thing, that like a driverless car could like show up even if you didn't order one. That'd be kind of weird, right? And,
Yeah, I'm
like,
not doing that.
Like, I mean, what if you don't want
I'd rather
it?
get into a car with a perfect stranger. Why,
Then
nothing about
Then no
yeah,
one at all.
of course,
Yeah. Okay. Well, it's an adjustment period for us all. All right. Joining us now is Dan Ives, Managing Director and Senior Equity Analyst at Wedbush Securities. I bet you he's probably bullish on Waymo and would totally get into a driverless car. No worries. Am I right, Dan?
I mean, I've done it.
Yeah,
Look,
okay.
I think end of the decade, I think 20% of rideshare are going to be no drivers.
But isn't it weird that they would show up, you wouldn't have a choice, and it would just be like, here's your driverless car, even if you don't want it?
Yeah, look, there's going to be clearly kinks to work out here, but I mean, and we'll see this at Tesla's Robotaxi Day, but the technology is starting to get to a point where this is no longer sci-fi. I know the next few years, it's something where the monetization is going to be clear. That's why you see that Uber Waymo.
Well, Dan, I should point out that you're in Bangkok. So it's like, what time is it? It's like midnight now?
On a Friday?
On a Friday?
I'd be out ripping it.
I know. He's a good guy. Dan, we appreciate that, by the way. I'm looking at Adobe. Adobe's down 9%. What was the problem with their earnings yesterday?
I think it's really just the softer guidance. But, I mean, Alex, in our opinion, this is just a transition in that Adobe story. I mean, when you look at AI and use cases, I think they are probably within 3 to 6 months of significantly benefiting from AI. Stock, obviously, is one of the core plays in big tech. But you look at Adobe, obviously a little softness, but then you look at Oracle, which I think is probably even more important to the broader AI story for big tech.
Then what about some of the other, so then how do we distinguish? What's the line item, right? And as an investor, how do you know when to buy that? You might see 3 to 6 months until we get a really big payoff for Adobe. How do you play it?
Yeah, look, that's why we do so much work in the field, because it's trying to figure out second, third derivatives of AI, who's benefiting in terms of real monetization. That's where you look at, of course, Palantir, Oracle, ServiceNow. I think Salesforce next week, some big announcements at Dreamforce, what they're going to talk about. Now, Adobe may be a little softer. They haven't seen it yet, right? So this is really going to be sort of pieces of a puzzle trying to figure out who in software benefits from the second derivative. Clearly, the hyperscale players, and we would argue even cybersecurity, are going to benefit as more workloads move to the cloud.
So, Dan, as soon as I get off the air here and finish up my 27 straight hours of radio, I'm going to go to my Apple Store app, and I'm going to pre-order that Apple.
Oh, this is today? You're doing it today?
I'm going to do it today. Yeah.
Oh, okay.
Already gave me my instructions. Apple 16 Pro, I'm going to spend $1 gajillion. How many people are out there are going to be doing the same thing? How big is this new phone?
Well, first off, I mean, I think it is huge news. The Sweeney upgrade.
Yes.
I mean,
No, it's huge. Like this is the top, or this is the start of the super cycle.
I mean, for years.
Exactly.
For years, the Sweeney upgrade. And I know, but Paul, I mean, I think now it comes down to, it's not just you. There's 300 million iPhones that haven't upgraded in 4+ years. And this is everything we're seeing here in Asia is showing that this is leading to what we believe is going to be an AI-driven super cycle. And I think we'll see this with pre-orders and obviously go into the next week. But I think demand's going to be pretty robust here. Street, I think, still underestimating what this is going to be about.
Okay, but are people in China really buying into that super cycle? Like, I know Asia is bigger than just China, but can we have a super cycle without a super strong China demand for the iPhone?
Yeah, so it's a great point. You cannot have a super cycle without growth in China. To that point, you have 100 million iPhones in China that are in that window of an upgrade opportunity. And everything we're seeing, that actually China, you will now start to see moderate to significant growth in the region from iPhone 16 over, call it the next year. And that's huge for Apple. I mean, that goes from a headwind to a tailwind, which is really key to this whole sum of the parts story as it plays out, and they monetize China front and center.
So, folks, when technology analysts like Dan Ives go to Asia, it's not just to see their clients. The big reason is to do what they call channel checks. Since much of global tech, hardware, software comes out of that part of the world, you get a good sense of kind of who's making this stuff, who's buying this stuff, who's selling this stuff. So, Dan Ives, what's kind of the vibe you're getting from your channel checks there in Asia these days?
Yeah, I mean, look, across Taiwan and I think just across Asia, demand is not slowing. I mean, it's accelerating in terms of broader when we look at from a chip perspective in AI, which I think is very, very important. I mean, Jensen talked about it this week. Demand's outstripping supply. We think 12 to 15x. And that is the most important thing, is the use cases, whether it's Oracle or Palantir, that will ultimately be the drivers. But enterprises, we're talking about $1 trillion of CapEx that ultimately is coming to tech over the next 3 to 4 years.
What is that? What you make of the NVIDIA rally the last 5 days? Like, how do you understand that structural shift and that thesis versus the daily swings of some of the biggest players, where seemingly they become more important than central banks some days and drag up the broader equity market? And I can't find a headline on that.
Look, I think that was a confluence of things, from the watch parties to technicals to just coming into September and obviously the macro sell-off tech front and center. But I think, look, anyone that's doing checks in tech, you're not coming back in any way negative on NVIDIA. I mean, it is actually getting more and more incremental, not just for NVIDIA chips, and I think broader the AI revolution. So we're going to have these ebbs and flows, but I continue to believe this will be a tech market that ultimately rallies into year end, because I think it all comes down to fundamentals. And macro's going to do what macro's going to do, but we are not seeing any. So it is an acceleration clearly that we're seeing over the last few weeks.
All right, Dan, thanks so much for joining us there. As always, appreciate it. Managing Director, Senior Equity Analyst for Wedbush Securities. He's Bangkok, Thailand. Go out and get into some trouble. That's an order. So Dan Ives doing it for us again there. Bullish, seeing some channel checks there in Asia suggesting that the demand continues to be there, not just for, I guess, AI chips, but just for tech in general.
I feel like he's been in Asia for like a month. The last 3 times I've talked to him, he's been there every time.
4 or 5 times a year, I think.
Oh, yeah. But what I think it's interesting, like, we can always joke about Dan Ives being the bullish guy on tech, for sure, but it's so interesting to get that take on the structural shift versus a cyclical market, and sort of understanding how the cyclicality makes sense when we're all transitioning to a different kind of world. And we can see that in lots of other sectors as well. Obviously, energy is one that I'm going to be paying attention to, but cars with EVs and the structural issues with that. So it's kind of fun.
Yeah, absolutely. Looking at the markets here, you got the green on the screen here. The S&P 500 up 0.6%. Same for the NASDAQ. I'll point out the Russell. The Russell's up 2.1%. So that broadening out trade, that repositioning trade, maybe coming out of some of the bigger names, going into some of the smaller cap names as people look for value in the lower interest rate environment.
All right, looking forward to that. Coming up, we're going to talk more about housing. Prashant Gopal is Bloomberg News U.S. housing reporter. Apparently, the worst key season in years for the U.S. housing market. This is Bloomberg Intelligence.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Friday, everybody. We made it to the end of the week. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio, and we're broadcasting to you live from our Interactive Broker Studio right here in Midtown Manhattan. So I know Paul is eagerly watching that 30-year mortgage rate. He's looking to refi. We're definitely not there yet. Looking for a low 5 handle, so that's one part of it. But back in the spring selling season, which is usually the hottest time with which to do that, apparently, it was pretty grim. Prashant Gopal is Bloomberg News U.S. housing reporter, and he joins us now. So this is your article about the housing markets kind of waiting for that low rate moment. What has it been like so far?
Well, you know, you've had rates come down pretty significantly. I mean, over a full percentage point. And, you know, you would think that that would spark demand, but it really hasn't moved the needle very much.
Well, why? Oh, sorry. No, go ahead. Why is that?
Well, it's a little, you know, there could be a variety of reasons. Like one thing is, like, I think a lot of people are anticipating that, you know, rates will get lower. So they may not be as eager to jump right now. You could also just have, you know, there's this thing called the mortgage rate lockdown effect, which I think is people know about now, but when I've been talking about this for many years, and now, you know, you have this sort of situation where nobody wants to sell their homes, because if they did, they'd have to give up that great low mortgage rate that may never happen again. So that's keeping the inventory tight. So there's not enough inventory. That's a big issue. So the inventory's crept up a little bit, but really it's way lower than almost any time in history.
Prashant, when you talk to your sources, do you get a sense that there's a clearing rate that would unlock those sellers there, whether it's a 6%, a 5%, does it have to have a 4 handle? Where do you think mortgage rates need to go to kind of free up some of the supply?
So I think, you know, I do talk to experts, and they're kind of, you know, to some extent, I think they're making it up, because I think we don't fully know. But like they say, you know, some of the folks are saying 5 or 5.5% might be enough to kind of, you know, make people start to jump. Others say, you know, it may not even have to get that low if there's so many people who've delayed their sales, you know, even the drops, you know, just below 6% or something. People might start to move, but not until there's more supply, maybe sometime next year.
So it was interesting. I was talking to an economist yesterday, and this was like, you know, just broad strokes here. Do we come to a point if, like, I have a 2.75% 30-year fix, right? Never moving, not happening, period, and goodbye, right? So does that, in essence, wind up making the transmission mechanism from Fed policy to the real economy much, much different? Because I'm not going to be affected in that way when it comes to housing by the Fed. And there are a lot of people in my spot. Does it, like, how does that, like, broadly wind up playing out, Prashant?
Well, the Fed's, like, you know, has this balancing act that they're involved in now. And, you know, I think the goal here is to avoid something severe, like a recession, right? So they're sort of trying to work on a soft landing. The question is, you know, if it's really just a soft landing, then, you know, they're not going to have to cut very aggressively. And if they don't cut aggressively, will rates actually fall enough to jumpstart the housing market?
Prashant, is there, I guess one of the themes I've learned about the residential real estate business is lack of supply, real constraint of supply. And we're in a housing shortage, particularly affordable housing. How did we get here, and how do you fix it?
Oh, wow, that was a long road, but, you know, it had, the seeds of it were, you know, it happened with the great financial crisis. So what happened is you ended up with builders who were gun shy. You know, they overbuilt before the crash and got in trouble. They were going further and further out. So they were really reluctant to crank up the engines, you know, enough They didn't keep up with sort of household formations. So we just had, many years of underbuilding. And then you have, people aging in place and, not necessarily, they're living in houses that may be too big for them. A lot of, there are demographic issues. There's like, it's layer upon layer, but, the big thing was what happened with rates during the pandemic, which really kind of, left us where we are now.
All right, we appreciate the insight. Thank you very much, Paul. Still waiting for his refi level. Prashant Gopal is Bloomberg News U.S. housing reporter joining us on the market. It was interesting. The Fed comes out with their sort of household exposure to stuff, and apparently household exposure to real estate remains near its highs. If you look at it as a real estate equity versus net worth, that chart, there you go.
Yep.
Straight line up at the end of the day.
Absolutely. So, and again, looking at the Mortgage Back Association 30-year fixed, 6.29%. So, tracking down, but still for, I guess, a lot of folks still too high to get them to get out of an existing home and make a move.
But also the idea you have to wonder too, is this a structural shift? Like, are there a lot of people like me who are going to have to come to terms with anything I do if I buy is going to be higher than what I pay?
Yep.
Is this truly like a shift, a structural shift within the market that definitely changes a lot of financing, et cetera? Anyway, we got a lot more coming up for you in the next hour of Bloomberg Intelligence. We are going to get a take on the market. Mandeep Singh will be joining us, Bloomberg Intelligence Senior Tech Industry Analyst. He's talking about Waymo and Uber. I bet you he's totally taking those self-driving cars, by the way, in Austin. And Shana Sissel of Benrion Capital Management. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Friday, everybody. I'm Alex Steele alongside Paul Sweeney. Welcome to Bloomberg Intelligence Radio. We broadcast to you live from Interactive Broker Studio right here in Midtown Manhattan. And we have a great Bloomberg Intelligence lineup for you over the next hour. Mandeep Singh will be joining us in just moments to talk about Waymo and Uber's partnership. He's been talking about this for quite a while. Also, it's Munis in Focus Day. It's Friday, so bam, Bloomberg Intelligence Senior Municipal Bond Strategist will be joining us. Plus, Diksha Gera, Bloomberg Intelligence Senior FinTech and Payments Analyst as well, and Lee Klaskow, Bloomberg Intelligence Senior Transport, Logistics, and Shipping Analyst. Apparently, it's not just the Boeing thing. There's a looming port strike in the U.S.
I know.
I
think
didn't know
East
about
Coast,
this.
I think this time.
Oh, boy. Okay, so we'll talk to him about that as well. But let's get you caught up on what's happening in the market. Here is Charlie Pellet with a Biz Flash. Charlie.
Hi, thank you very much. Alex and Paul, we got stocks higher across the board on this Friday. And this Bloomberg Business Flash brought to you by Commonwealth. Join over 2,000 independent financial advisors who are taking control of their growth with advisor-centric support and future-ready technologies. Grow on your own terms with a partner dedicated to your success. Go to commonwealth.com to learn how. Wall Street traders have revived prospects for a half-point Federal Reserve rate cut next week, spurring a rotation into stocks that would benefit the most from policy easing. Stocks are gaining. S&P right now back at 56.24, up 28 now, an advance of 0.5%. We've got the Dow up 286, higher by 0.7%, and NASDAQ right now up 101, a gain of 0.6%. 10-year 3.66%, the 2-year yield 3.59%. Spot gold up $18 the ounce, another 18, another record up at 25.76, up by 0.7%. And West Texas Intermediate crude oil advancing as well today, up 1.3%, 69.89 for a barrel of West Texas Intermediate crude. So bottom line here, we do have the Dow, the S&P, and NASDAQ all advancing today. What to expect from the Federal Reserve and Jay Powell's news conference next Wednesday. Emily Rowland is co-chief investment officer at JH Investments. She was interviewed this morning on Bloomberg Surveillance.
If you start to hear the Fed coming out on next Wednesday as even a little bit more hawkish than what's already priced in the market, I think you might see a repricing there. You'd see bond yields backing up. That would likely cause the dollar to appreciate. It would put some some pressure on equity markets very likely here. So we've got to hear a more dovish Fed just to fit in with what the market is already pricing in.
Emily Rowland interviewed this morning on Bloomberg Surveillance. Boeing factory workers off the job for the first time in 16 years, halting manufacturing across the plane maker's Seattle hub. We got Boeing shares down now by 0.3%. Recapping, stocks higher, S&P up by 0.5% for on-demand news. 24 hours a day, subscribe to Bloomberg News now, wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pelleton, thank you so much. We appreciate that. Alex Steele, Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube, so head over to youtube.com and search Bloomberg Live Radio, Bloomberg Podcast. Either way, we'll get you where you need to go. Red headline across the Bloomberg terminal. Ares said in advanced talks on deal with GLP Capital Partners, so we'll have some more reporting on that going forward, but maybe a little bit of a deal making in the asset management business. As Charlie was just reporting, a pretty solid tape here today. Now I'll call out the Russell 2000. I'm up over 2%, so the small cap is doing well. Let's check in with Abigail Doolittle. She covers the markets for Bloomberg, and she joins us here in our studio. Abigail, what are you looking at today?
Well, we do have stocks heading to the best week of the year. At least that's true for the S&P 500, up a very healthy 4% after having fallen about the same amount last week, the worst week since 2022. So we have this tug of war between the bulls and the bears ahead of the Fed meeting next week. And there was, of course, an article in the Wall Street Journal saying that policymakers are debating the size of the rate cut. So for that reason, at one point today, I think we faded a little bit. There was a 40% chance of a 50 basis point cut this month as opposed to 25. It's going to be really interesting. I think that this meeting, people are really going to be watching to see what does the Fed do and what sort of language do they give. Beneath the surface, lots of movers, of course. Today, the S&P 500 up about 0.5%. The worst stock, Adobe, from a percentage standpoint, is also a big point drag, down nearly 9%. They put up a good quarter, but the strength simply did not extend into the future, having to do with some of their AI tools. On the other hand, you have Uber up for that Waymo self-driverless car deal, and Alphabet, for that matter. Waymo, of course, Google's or Alphabet's driverless unit. So lots of interesting sub-stories beneath, a pretty solid surface.
Yeah, I was interested in that Wall Street Journal article about sort of raising the prospect of 50, and I have to wonder if the goal is to just keep optionality, right? Like we don't want to go too one-sided. We want to keep the optionality in terms of the market. Do you see that in the options market at all, or when you talk to your traders?
So based on the chatter that I've heard, most, and I wouldn't even say traders necessarily, most strategists are thinking more aligned with 25 basis points. I think that if they do cut by 50 basis points, it does bring up that question of, is there a real issue here that they're racing to get this cut in? So that's some of the chatter that I've been hearing. And I think, frankly, that's a piece of the uncertainty that we've seen when we play through the effect of these cuts on yields, of course, down dramatically. The 2-year yield at, my gosh, 360, the 10-year yield at 366. So we, have that normalized yield curve coming into play. Of course, the inverted yield curve signals a recession. I think that we're seeing all these mixed signals around the consumer. It's a little bit concerning, but something else is that dollar yen, when yields go down, that causes that Japanese yen to strengthen. Its dollar yen's at lows. Right now, it's not hurting, but if that drop continues, it could be taken as a continuation of the unwind of that yen carry trade and a bit of a risk-off sentiment.
I called out earlier that the Russell up 2% today.
Yeah.
And, does this trade still have legs, do you think? There's kind of maybe a little bit of a rotation to some of the small cap names?
So it's funny. I think that Russell 2000 has actually exactly to do with what we're talking about and the possibility of a bigger rate cut than anticipated. Now, if I were to describe what the Russell 2000 looks like for our listeners, it's a very choppy up and down uptrend over the last year. That said, it's still about 10% below its all-time peak a couple years ago, unlike the big cap indexes. Yep. I think it's too early to say whether or not we're going to see some kind of a breakout where the small caps are really going to be the next play.
Right. Yeah, it's like, yeah, they're the trade for how long? A couple
Yes.
weeks, and then maybe if we're lucky. All right, thanks a lot, Abigail. I really appreciate it. Abigail Douglas joining there. From Bloomberg, right? Let's go to that Uber story. So the headline, obviously, is that Uber will be the sole app offering driverless rides in Google's Waymo cars in Austin and Atlanta. This is a boost, obviously, to the autonomous vehicle arena. Want to get more on it with Mandeep Singh, Bloomberg Intelligence Senior Tech Industry Analyst. Mandeep, your take, any of this a surprise?
Actually, I am surprised by the exclusivity of the pact. I would have guessed that Waymo would have gone direct as well as, partnered with the ride-sharing companies as they've been doing in the other 3 cities they operate in, Phoenix, LA, and California. So it is a surprise why they are going exclusive, but I think it helps Uber in that sense that they won't be disintermediated, because the way I look at it is, if I have the option to order direct from Waymo and it's a cheaper ride, I'll go there. There is no kind of loyalty when it comes to, a specific app. I'll go with the lowest price. So in this case, the exclusivity does make a difference.
What are some of the early returns in terms of consumer uptake of these driverless rides? I mean, I'm just thinking about myself, like, I'm saying I would never do this, but I mean, I climb into a car with a dude I've never even met. I don't know who this person is. It's kind of the same thing. I don't know. So what's been the consumer kind of take-up?
Actually, there is some survey work that suggests that consumers may actually prefer a car that doesn't have anyone, because when you are taking an Uber, yes, there is that element that the driver is can be a nice guy, or who knows. And so that's where having a car that's reliable, that can go from point A to point B, and if it's a short trip, all you care about is the reliability, and you don't want the elements that can make for a bad trip. I think you can use your phone, you can do whatever you want in an autonomous ride. So there seems to be a preference for those kind of rides, and if Waymo is able to scale this, I mean, this could be huge when it comes to the take rates and the unit economics of ride sharing.
So yeah, so do we know any of the economics here for what this deal looks like and all that?
Nice.
Well, we don't. And look, they just put out a press release, but the way to frame this is Uber right now takes at least a 30% take rate when it comes to, let's say, $50 ride. Uber is getting, $15 as their take rate. Now, the service they're providing is they're doing the background checks, they are providing the customer service. In this case, they have to provide the maintenance of Waymo vehicles. They have to provide, the charging, the parking, the cleaning, the repair. So all that adds up in terms of fixed costs. And that's where I feel that 30% take rate is a cap for now. I think their take rates will go down. So even though I like the fact that it's exclusive, from a unit economics perspective, the incremental margin for Uber will be lower here.
All right, Mandeep, I don't know. I'm not sure I'm doing this thing, but I'm not going to be a test market person anyway.
No, you're the
demo.
late adopter.
I'm the late adopter. Thank you very much. All
You're
right. Very good there. Mandeep Singh, thank you so much. Mandeep Singh, he's one of our senior tech dudes. But we had Anurag Rana earlier today, and Mandeep Singh as well. So 2 of the top tech analysts at Bloomberg Intelligence, getting to chat with them today. All right, what are we doing here with these markets? That's a lot of folks are trying to figure out as they think about next week when we get the Federal Reserve giving us their thoughts on earnings. Shana Sissel joins us. She's president and CEO of Banrion Capital Management, joining us from Chicago via Zoom. Shana, thanks so much for joining us here. We've had a whole slew of economic data really over the past couple of weeks. You put it all together, and it seems like the market is getting ready for the Fed to begin cutting rates. How are you guys positioning kind of your portfolio, and what are you telling your clients?
Well, as much as I love to be a contrarian, I am in complete alignment with market sentiment and that the Fed will cut at this meeting. Chairman Powell has been very transparent, and in his remarks at Jackson Hole, he was very clear that it was time to make a pivot from their previous roadmap to make changes, and cuts were part of that change. So I agree with the market. I think where the debate comes in is how big that rate cut will be. And as you noted earlier, the market probability for a 50 basis point cut is actually rising. And I'm not sure I understand what is driving this belief that the Fed will cut 50 basis points. They've been super cautious. And I just can't imagine cutting 50 basis points without seeing something in the economic growth activity or in the U.S. economy that warrants that kind of what I think would be kind of a knee-jerk reaction. So we're telling clients, to prepare for a loosening cycle. The Fed is obviously loosening policy, and we want to take advantage of that, which in an economy which is fairly stable means that it's a risk-on environment.
So let's go back to what happened in NVIDIA in the last 5 days, right? I mentioned this yesterday. Charlie Mangala over at Nomura said that NVIDIA was basically the central banker of power, that, we can look at the Fed, but it was NVIDIA and the FOMO that kind of gripped the market that has really propelled the S&P higher this week. What matters more for you and your asset allocation? Is it what's happening with NVIDIA stock or what Jay Powell says on Wednesday?
What Jay Powell says on Wednesday.
Oh, man, I was really hoping you'd say NVIDIA. You're killing me.
Sorry, I know. I love NVIDIA. I do. But as much as we want to pretend it's a proxy for the economy, and it is to some extent, we should not be basing our portfolio management decisions on the technical trends of a single stock, especially one which is kind of, shrinking in terms of its growth potential. It's an amazing company. It's growing, triple digits, but it's growing at a slower rate than it was a year ago. And that is reflective of what I think the economy is doing. But the Fed's policy is, at the end of the day, what drives the underlying market liquidity and the underlying opportunity for investors in banks or whatever to access capital. So, NVIDIA is great. And control access to capital.
So I guess just looking at the equity markets in general, give us your thoughts on valuation here these days. A lot of folks feel like it's stretched. A lot of folks will say, yeah, but if you pull out some of those big tech names, not so much so. How do you guys look at it?
So I learned at Fidelity, and this is super basic, but I think it's actually a really great tool for people out there who just want to do like quick math in their head. But I learned the rule of 20 during my days at Fidelity. So that is taking the PE of the market and adding in the inflation number, and then looking at it on a historical basis. And the general consensus is if it was valuations were above 20, it was stretched. And if it was below 20, it was attractive. And so we're well above 20. Yes, some of that has to do with tech stocks, and how much they are kind of weighing on the market. But I think even in the equal weight indexes, we are above that 20 number. And so there's definitely opportunities in the market, but it feels like we're a little frothy here. I don't think we're super expensive by any stretch of the imagination. But I do think that I wouldn't call the market cheap.
Favorite pick right now?
She hates all my
questions
now,
today.
I really like Apple.
Okay, why?
So the stock got beaten up, and then they had their iPhone event last week, which was sort of like anticlimactic. So the stock has been kind of, not doing much for a while. Valuation-wise, it's attractive when you compare it to the rest of the Mag 7. And I think that overall, they're doing the right things to maintain market share. And I think that there's the potential for them to take market share in the future. So, from that standpoint, I think Apple has the ability to grow their global footprint. And people like the ecosystem. I'm definitely one of those people. The stock is relatively attractive on a valuation basis, whereas you look at something like an NVIDIA or one of the other names in the Mag 7, and they don't look quite as attractive on a valuation basis.
Paul scrolling on his old iPhone, ready to buy the new iPhone very soon,
Yes.
as in like in 45 minutes time.
Exactly.
All right, Shana, thanks a lot. Really appreciate it. Shana Sissel, President and CEO of Benrion Capital Management, joining us there. Thank you very much. All right, coming up, we're going to go to Munis in Focus because it's Friday. Eric Kazatsky is Bloomberg Intelligence Senior Municipal Bond Strategist. He'll be joining us on the trends in the Muni market. Plus, Diksha Gera is Bloomberg Intelligence Senior FinTech and Payments Analyst. We're going to talk about the buy now, pay later industry. Is that still a thing? I genuinely don't know. We're going to talk about Affirm and the impact of Apple really opening up its payment platform. We'll break that down right after the break. All right, taking a look at the markets here. You're looking at an S&P up by 0.5%. This is
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg. Stocks are pushing higher with the Dow, the S&P, NASDAQ solidly in the green. A 305-point jump right now for the Dow Jones Industrial Average, up 0.7%. S&P's up 31, 56.27, higher by 0.6%. The NASDAQ Composite Index up 119, now up by 0.7%. 10-year at 3.65%, with a 2-year that's yielding 3.59%. Gold continues its advance, another record $25.77 the ounce, up 0.8%. And West Texas Intermediate crude oil is higher by 1% now, $69.61 for a barrel of WTI. Wall Street traders have revived prospects for a half-point Fed rate cut next week, spurring a rotation into stocks that would benefit the most from policy easing. Shana Sissel is the president of Banrion Capital. Moments ago here on Bloomberg Intelligence, she told us yes to a rate cut next week, but it will not be 50.
I just can't imagine cutting 50 basis points without seeing something in the economic growth activity or in the U.S. economy that warrants that kind of what I think would be kind of a knee-jerk reaction.
Shana Sissel of Banrion Capital. Uber will be the sole supplier of driverless rides on Alphabet's Waymo cars in Austin and Atlanta, a boost to the rideshare app's ambitions in the autonomous vehicle arena. We got shares of Uber surging today by 5.1%, rival Lyft slumping down 2.8%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Now on Bloomberg Intelligence, Munis in Focus.
All right, today's Focus on Munis is brought to you by BAM Mutual. BAM Mutual insures municipal bonds that finance essential infrastructure and provides guaranteed income to improve any portfolio. Part of building America. Invest in BAM.
BAM.
Insured bonds. There you go, just in time. All right, we're joined by our good friend Eric Kazaski, Senior Municipal Strategist for Bloomberg Intelligence. And Eric, we got a Fed meeting tomorrow. I mean, next week, next Wednesday. I think it's kind of important for financial markets. What's the municipal bond market looking for?
Well, it's quiet. And if we're judging by the activity in our BI Anonymous Muni chat room, people are going to be sitting on their hands until the Fed does something next week. And as the previous guest just alluded to, right, the odds are now pointing to a 50 basis point cut, but a lot of people aren't seeing anything really scary in the economic prints that would really point to that being warranted. That being said, I think the bigger thing from our market is how is a rate cut going to impact munis? And I think it's going to be pretty beneficial.
So, Eric, Anonymous Municipal Chat Room, I mean, Alex Steele just jumped out of her seat. I think she wants to join. Can she join that chat room?
Probably not.
No, unfortunately, we can't have anyone but BI folks in there and everyone from the market.
Right.
I know.
All right. But what about the whole issue before the election thing? Where are we with that on munis?
Yeah, I mean, I think the muni industry right now is pretty agnostic to whoever gets in the office. And I think what we've seen right now is a lot of issuance come to the market in fear of higher taxes, right? The federal government's running trillions in deficits. It really has to be something to be contended with. And the only way to really do that is to let some of these provisions of the TCJA roll off, top tax rates go higher. And that's going to boost the value for municipals and the value of that exemption.
U.S. banks have unrealized losses. They totaling about $512 billion in the second quarter of 2024. Why is that important for the bond market, including the municipal bond market?
Well, it goes back to that sort of debate between 25 and 50, right? If you look at all those unrealized losses, and if you sort of zoom out that chart that you're referring to, right, even in the GFC, the unrealized losses on bank balance sheets weren't as large. So the Fed really has two options, or regulators have two options. One, they could require more capital from banks, which is definitely an unappealing option. Or two is to be more aggressive with rate cuts, which is, I think, why you see at least some of the odds pointing to a greater likelihood of a 50 basis point cut, just to get ahead of some of those bond losses, right, and sort of narrow those gaps.
What do you think this does, though? Okay, fair enough. But if I have money in money market funds, when am I going to put that into a muni market something?
Well, I mean, if they're cutting 50 or they're cutting 25 now and 25 at the next meeting, right, you're in a floating rate product on the very short end of the curve, and you're going to find yourself short of yield very quickly. So I think the impetus now is for folks to roll out of those money market instruments and lock in higher long-term yields, right? On a like-over-like tax equivalent yield basis, munis are still a very attractive option over corporates, over treasuries, and over most other fixed income assets.
Fair enough.
New issuance here. I'm thinking last week, I think it was Tuesday and Wednesday in the corporate bond market, just an explosion of new issuance. What are we seeing on the municipal bond front?
It's fairly strong, right? We're up 40% year-over-year volume, which we'd love to see, right? Lots of money sloshing around. Deals are still well oversubscribed, which means there's ample demand there. You know, looking ahead for the next week or so, some interesting deals, some multifamily housing deals, right, which sort of falls in line with Vice President Harris's, you know, sort of policy push to talk about, getting more housing online, and also some interesting deals as far as, some ESG stuff coming online and financing for the new Bills Stadium, something that's always interesting that when you see the public on the hook for, sports stadiums getting built.
What other cool stuff are you looking at?
Other than that, I mean, the spate of issuance has really kept us busy. It's been like drinking through a fire hose. As busy as the people have been on the sell side and the buy side digesting these deals, my associate and I have been quite busy just trying to figure out why spreads haven't widened.
Yeah, that's a good question. I mean, is it also, do we have a lot of foreign buyers that come in? I mean, is that like the who buys and the amount of people that buy, is that changing?
You know what? There are a good amount of foreign buyers, and they're focused in that taxable muni market, one of Paul's favorite subjects, as you know. But, that's another sort of knock-on effect of rates going down, right? It's going to bring that taxable muni supply back into the market. They're going to be able to refund some of these exempt deals at more favorable rates. And so that's always a good thing. And a lot of foreign buyers are looking at the muni market as sort of this uncorrelated risk basket that they could get U.S. dollar-denominated exposure, but not be tied to equities or corporates if we are going into a recession.
All right, Eric, thanks so much for joining us. Really appreciate it. Eric Kazatsky, Bloomberg Intelligence Senior Municipal Bond Strategist here, talking about the municipal bond market. Again, poised for next Wednesday, September 18th. The Federal Reserve will meet at 2 p.m. Wall Street time. Press conference 2:30. I'm sure Bloomberg Television will have simulcast coverage with Tom Keene and the surveillance team starting at 1:30 p.m. Wall Street time to get you through the Fed day. I think it's a scam. Buy now, pay later.
Yes.
Isn't it just like credit, right?
I don't know what the difference, I mean, I understand the difference between that and a credit card, but I don't know how I would use it differently than a credit card.
Okay, I think the kids are doing it, but we have an expert in our studio.
I would definitely not want my kid to do this,
Yeah,
but go ahead.
It's not happening. Thiksha Guerra joins us, Senior FinTech and Payments Analyst for Bloomberg Intelligence. For folks like the demo of Alex Steele and me, what is buy now, pay later? Where did it come from? Who's using it? What do you think?
It was like it's like a layaway plan, but different.
Yes, and thank you so much for starting with that introduction. The kids are doing it.
Yep.
And the funny part is I was at a panel at Finovate talking about the buy now, pay later topic, and we did a survey, like show of hands in the room. All the millennials and the Gen Zs were like aware and using the product versus the Gen Xers, baby boomers who were completely skeptical. So just to clarify, buy now, pay later means different things to different people. The classic pay in 4 model is where you pay 25% of the good upfront, and then you pay 3 installments of 25% each over a period of 6 weeks. If you don't pay up that $100 bill, you get cut out. You're not getting any more credit. So that is buy now, pay later in simple terms. The other offshoot of that is the installment loans, which is anywhere between 12 months to 5 years. And that's which is slightly higher duration, longer duration loans. And that kind of people tend to confuse with more credit card kind of spend. So that in a nutshell is how buy now, pay later is different.
Okay, so, but the whole you can pay in installments, that reminds me very much of like if I go to Home Depot and I get a credit card and it's 0% interest if I pay the minimum each month for like 12 months or something. How is that different then?
So you're not paying the minimum. You're paying the installment that was due in that period. And so the interesting part is a lot of people get confused that, oh, this is off the system, this is off the record, like there's shadow lending sort of vibes to this. It's not. Any delinquencies in the installment loans are getting reported to the bureaus. And by the way, the pay in 4 is the dominant part of the buy now, pay later. And I think Max Levchin did an amazing job by clarifying the numbers. This is a duration of 3 weeks loan. And you can compare that the entire market of pay in 4 was $50 billion. Add that to the weighted average, it's 52 weeks in the year, 3 weeks average, it's about 18. It's a $3 billion credit market that we're comparing against the credit cards outstanding of 1.1 trillion. So it's a very different game. I think what is really changing is people are starting to look at it as an alternative method of payment rather than credit cards just where you keep revolving debt and you can just pay the bare minimum and keep building on leverage on your portfolio.
So if I pay 25% now, then the other 25% installment. Is somebody financing that float there?
That's a very good question, Paul. So a lot of credit cards is just banks taking a bet on your credibility, right?
Okay.
What is different with buy now, pay later, and a lot of people don't appreciate that, is you're not underwriting the person. You are underwriting the transaction of that credit. So if someone's going and buying like a $200 product at a Walmart and that's financed by buy now, pay later, it's not that you are going to give them a credit line. It's the buy now, pay later provider will decide whether you are eligible to get that $200 credit at that point in time to buy that product. What is the economics around it? Walmart is subsidizing that. Yes. Part of it comes from merchant discounts, which is part of the MDR deals that a lot of these companies run with them. And the other part of it is your credit worthiness. Like, do I trust you? How much do I know you? How frequently or how promptly have you paid in the past for me to be able to judge your credit worthiness? And all of those factors are driving the economics of this, unlike some of the other deals that you've seen, right? Like banks are providing after pay later options now. When you go to your Amex credit card bill and you see a chunky item and it asks you want to pay later, that's different from what this buy now, pay later is.
This is actually extraordinarily helpful in the details for that. So is a company like Affirm profitable with this?
So they've announced that they're going to turn profitable by the fourth quarter of coming fiscal year, which was...
And they make money by being paid by, say, Walmart, for me doing a transaction through them on Walmart.
Exactly. So that is part of it. The other part of it is obviously interest income that they earn on the installment loans. And the point to note here is Affirm's delinquencies have been really amazingly contained compared to what we're seeing in the consumer credit space.
Huh, why is that?
So that's exactly the point that I'm making. It's a short duration loan that we're talking about. By the time the company reports their earnings, the loan is already paid off, the book has already moved. The ability to control your credit at that duration, and I can cut you off at $100, by the way, Alex. I'm not going to wait for you to kind of default on a $1,000 loan or a $2,000 credit card bill. Mm-hmm. So that gives you a lot of lever to control credit quality. And I think that's the interesting part about this product. And the way it'll pan out, I mean, we'll see how the future was with Apple coming into the picture, with Amazon kind of taking on Affirm. So yeah, exciting days ahead.
Oh, thank you. That was awesome. Yeah, I did learn a lot. I don't think I'm going to use it, but I've been more tempted recently when it's like I don't need to spend all this money now, but I kind of need to buy this table.
Furniture for the Jersey Shore compound, and they gave me a 0% 12-month loan, which was I'm like, yeah.
But that was a buy now, pay later, or through the store?
No, it's through the store. I think.
Right.
I don't know.
Which would be different.
I said 0%. I said, yeah, okay.
Now pay later offering that, so it's a 0%, and I used it just for that.
Okay. Very
interesting.
Good.
I like it. Diksha Gera, thank you very much. Bloomberg Intelligence Senior FinTech and Payments Analyst. Much more coming up. This is Bloomberg Intelligence. Happy Friday.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. We do check markets all day long here at Bloomberg. I'm Charlie Pellet. We have got the Dow, the S&P, NASDAQ solidly in the green on this Friday, on track for a winning week. For the week so far, the S&P 500 index looking at a gain of just about 4%. Today, stocks are moving higher as traders revive prospects for a half-point Federal Reserve rate cut next week, spurring a rotation into stocks that would benefit the most from policy easing. Here's where we stand. S&P 500 index right now up 32, up 0.6%. The Dow up 361 points, up 0.9%, and NASDAQ up 110, up by 0.6%. 10-year 3.66%, the 2-year 3.60%. Spot gold climbing by another 0.8%, up another $20, $25.78. That is a record. And West Texas Intermediate crude 69.52 a barrel, up 0.8%. There's now a third round of tame U.S. inflation data, fueling speculation the Fed will cut rates next week, the first easing in 4 years. And with that story, here's Bloomberg's Vinny Del Giudice.
Import prices dropped in August, falling 0.3%, the sharpest decline since December. The government's import price index follows this week's generally tame reports on consumer and producer prices. Regarding the Fed, Bloomberg Economics says it's a close call on a quarter-point cut or half-point cut at next week's policy meeting. Meantime, a Bloomberg survey of investment industry economists points to a trio of quarter-point rate cuts through the end of this year. Vinny Del Giudice, Bloomberg Radio.
Oracle says annual revenue will rise to at least $104 billion in fiscal 2029. Oracle today up by 1.2%. Briefly after earnings, we do have shares of Adobe down now by 9.3%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Alex Steele, Paul Sweeney, live here in our Bloomberg Interactive Brokers studio, streaming live on YouTube as well. Let's talk all things logistics. We can go rails, we can go trucks, we can go the ships, we can go the air stuff, anywhere. We can go with Lee Klaskow, Senior Transport and Logistics and Shipping Analyst for Bloomberg Intelligence. First, let's start with some potential strikes looming for some of the ports. I thought we just got done with this on the West Coast in L.A. Where are they potentially striking next?
Well, the potential strike would be in the ports along the eastern seaboard and the Gulf ports. There's a contract that comes due on September 30th, and both sides are kind of real far apart. So there's a real risk of a strike. We've been seeing freight being diverted from the eastern ports to the western ports. We saw some pull forwarding affected demand. People trying to get stuff into the ports before that September 30th date, which is really just around the bend.
How did we get here?
Well, they have a contract at, I think it's a 5-6 year contract. And, as you guys are probably aware, it's been a pretty good year, 2 year for labor in terms of negotiating. So they're looking for something like an 80% increase in rates over the time of the contract. Because in years past, they would say that they probably weren't getting their fair share. So they're looking to get their fair share. And there's probably some sticking points on automation. Obviously, labor is never usually happy with that, but port operators like to increase the amount of automation just to be more productive and more competitive with other ports, because some of the ports in Asia are extremely efficient because of the amount of automation that they have. So it'll be interesting to see. We think that there probably will be a strike. It will probably not be a long strike, but it'll be disruptive nonetheless to the supply chains.
So where does stuff come into and go out of the East Coast? Is it primarily Europe? I'm not sending a ship from Asia through the Suez to the East Coast, do I? Or don't I?
Well, certainly not now, because the ship could.
But I just dump it in LA or something, right?
Yeah. So if it's Trans-Pacific, it's probably going through. Into LA or Long Beach or Port of Prince Rupert, which is in Western Canada. Those are usually the main entry points, or Vancouver. But what you do have is a ship could go through the Panama Canal and then go into the Gulf ports or the eastern ports.
Which has its own problem, Panama Canal, in terms of the hue and all that stuff.
Yeah. So that has gotten better, which is good, but it's not back to where it should be. And they do a lot of imports. I mean, New York, New Jersey is the third largest port in the U.S., third busiest container port. So there's stuff, containerized traffic, whether it's from Europe or from Asia or other parts of the country that come in through that gateway. And these ports also export a lot of commodities like coal.
Yeah, I got my marine traffic app.
He does.
So I'm
Did you know this about him?
I did not know that.
So I
he
sit
sits
on the beach.
And, go ahead.
Sit on the beach and I see a tanker. I said, I wonder where that's going. 9 times out of 10, they're either going or coming from Norfolk, going to Europe.
Yeah.
So anyway.
Cool beans. So aside from that, Lee,
it's a good way to pick up girls at the beach.
You're like, hey, can I show you where that tanker's going? They're like, no thanks.
Has it worked?
Not yet. I'll let you know.
Hey, Lee, so then the 80% increase, though, if we stay with the East Coast ports, is that like realistic?
I don't think so.
Okay.
It probably, it's probably a negotiating tactic, I would imagine. But if these are 5 or 6 year contracts, so even if you're doing 4 or 5% rate, wage increases, that adds up from a CAGR. So you could see very high numbers over the life of the contract.
What is going on in the C-suite of Norfolk Southern? I mean, a little hanky-panky, so we lost...
Nothing now.
Nothing now. And so...
Well, the CEO and the chief legal officer were just recently let go due to a consensual relationship that they had that was against company policy. Now the CFO is the CEO. Norfolk Southern's an interesting story. They fought off an activist.
Yep.
They have the activists won 3 board seats, but they didn't win nearly as many board seats as they wanted, and they didn't get to push out Alan Shaw, the CEO, who just recently got pushed out. So it's a little interesting. This could be a made-for-TV movie, I think. But they really need to focus on operating a more fluid and safe network to drive better margins. Their margins are well below their peers. And it seemed like they had the right people in place to narrow that gap. And it'll be very interesting to see if the new CFO, who's now the CEO, is going to continue on the path that they're on, or maybe he might have a different vision. I suspect that they're going to continue on the path, and now we just need to see, whether it's the operations, the marketing, and the finance people to coalesce around, their new leader.
Mm-hmm. In your space, all the space with the moving of the stuff, where is the weak spot? Like in terms of demand or product? Give me the eco vibe.
Right. So the weakest in terms of rates right now is probably the truckload market. The truckload spot market, while rates are up 2 or 3% year over year, they're extremely depressed. It's hard for truckers in the spot market to make a living. A lot of that's to do because they have higher costs, whether it's insurance or the cost of their equipment. A lot of the publicly traded folks like J.B. Hunt, Knight, or Werner, they don't really operate in the spot market too much. They're mostly in the contractual business or dedicated business, but it has a ripple effect. So when they're trying to renegotiate contracts with their shippers will just say like, well, the spot rate is X, we want lower rates. So they're facing rates that are lower by mid-single digits. On the less than truckload market, it's really not about rates, it's more about demand. The ISM has been in contraction territory for something like 21 out of 22 months. That is a kind of leading indicator for LTL demand, so that hasn't been great. Less than truckload. Yeah. A couple of them reported their August numbers, XPO and Old Dominion, which were slightly lower than kind of the street were hoping. So a lot of earnings expectations are going to come down for the third quarter in the less than truckload market.
All right, Lee.
I did an equity deal for Old Dominion Freight Lines.
You did?
Stock symbol, ODFL.
Is this when you were sitting in that office in Virginia watching the trains go by?
No, but that one, this was a paid Wimmer even before that, going way back.
Great stuff. Haley, it's good to see you. It's good to see you in here. It's always good to get your perspective on everything. Lee Klaskow, Bloomberg Intelligence Senior Transport, Logistics, and Shipping Analyst. Quite interesting. We have the looming port strikes on the East Coast, Boeing strike. We had a summer of strikes that was supposed to resolve itself, and clearly that is definitely not the case, with double-digit increases now on the docket. Okay, coming up, we got more for you. Peter Robinson is Bloomberg News investigations reporter. We'll talk about college football players.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Friday, everybody. I'm Alex Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business and finance, economics from our beautiful world headquarters right here in Midtown Manhattan. There's a really interesting big take story today that everyone should read. You can find it, Bloomberg Big Take story about college football players facing an ugly truth about payment details. You can read the story on Bloomberg and at bloomberg.com/big take. But we're lucky to have Peter Robinson here. He's an investigations reporter here at Bloomberg News, part of this story. I thought college football players got their own money now, and that was awesome, and that was it. What's going on?
That's exactly what the popular belief is, and that's why my colleague Noah Buhire and I wanted to look into this, because if you are a casual fan and you hear about these deals apparently worth millions for college football players, you think, well, that problem of the players being exploited while the coaches and the administrators make millions has been fixed. But we took a really deep dive into these contracts, and they're at most of the big time football schools, they're controlled by booster groups, which are essentially wealthy individuals, think the richest car dealer in town. And they're in charge of the deal. They write the contracts. And we actually got our hands on at least 3 of these contracts. And in many cases, according to other people we've talked to as well, these come with broad termination rights, which wouldn't be seen in virtually any other industry. But there's one contract we looked at that said it can be terminated at any time for any reason. So players are essentially still being exploited. It's a version of the black market that's existed in college football for a long time.
Peter, by and large, do these student athletes have representation, whether it's legal or an agent, to kind of protect them here?
It's really catch as catch can, and it depends on the player. And you can imagine for someone who's a teenager, these are 17, 18, 19-year-old kids. They're entering this world for the first time, and a majority of the players in Division I schools are black, many from disadvantaged backgrounds. And so you have these situations where players are not aware of their options, they're not apprised of their options, and because it's a third-party relationship between the university and these donor groups, there's really no one looking out for their interests. There's no one accountable when one of these deals goes wrong.
So how do we fix this?
Many people I've talked to look at the pro leagues and they say what's happening in college football is a professionalization of college football. And in the pro leagues, the players collectively bargain. In the pro leagues, the NFL Players Association, for instance, requires that the contracts be disclosed to them so that all the players know what all the terms are. It's a very transparent, very fair market. And so many of the people I talked to said that that's exactly what should happen in college sport, at least in big-time college football, where there are billions being made.
These booster groups now have a new moniker. They're called collectives, which I think is kind of spooky in and of themselves. And we actually know some people that are parts of collectives of their university. And those are the ones that are, who's monitoring or regulating these collectives, if anyone?
Well, that's exactly the question. And yeah, you're right. The word collective hasn't been in popular use since the 1930s Soviet Union. But because of the way that NCAA has lost repeated antitrust suits and has lost the ability to enforce really any rules over college football, there is no one monitoring this. Congress has looked at this, has held a dozen hearings since 2020, but there just hasn't been the momentum for bipartisan legislation that might put some guardrails in this market.
What about the whole, and forgive my complete lack of knowledge, the likeness thing, like image of likeness? What's that called? What's the
NIL?
NIL.
And that's what we're talking about.
Yeah.
Okay.
If you follow college sports, you
clearly I don't. But go ahead.
Well, I'm saying, that name, image, likeness has become. It's amazing how rapidly it's become part of the daily coverage in sports, and it gives people the impression that athletes are signing endorsement deals with Nike, with Adidas, that they're out there on social media. But the interesting thing about college football is that although there isn't really good statistics about this, the best statistics we have show that about 80% of these NIL deals are actually from these collectives. So people have the impression that Adidas and Nike are pouring money into the sport, into especially specific players. But at least as far as what the players are making individually, that's not the case. It's still these collectives that are in charge.
And Peter, is this a case so far with the big stars get most of the money, and if you're in like an Olympic sport, you're not getting much, if anything?
Yeah, it really depends on the individual athlete, and like the rest of the economy, it's a star system. We looked closely at these contracts and talked to agents, and what's happening is that if you are a star with leverage, you can make a starter at a power conference school in football can make in the six figures every year. But if you're not a starter, you're on a month-to-month contract. If you don't perform well, or if you're injured, that money goes away. So it's just not a guarantee, especially in the same way that coaches have. Coaches even assistant coaches in college football can make 400,000, even up to 2 million and up.
Wow. All right, Peter, thanks a lot. We really appreciate it. It was a really great piece, everybody. Peter Robson, investigations reporter, joining us from Seattle, Washington. Again, you can find that story on the Bloomberg and at Bloomberg.com/bigtake, talking about college football players facing an ugly truth about how they actually get paid for stuff. That wraps it up. We made it through Friday.
Yes, how about that?
Whole lot of nothing happening in this market, guys. You got the S&P up 0.6%. I know we're up, but volume's still really light. Year to date, the S&P is still up like 18%. Who would have thunk it? All right, Balance of Power is up next with Joe Matthew. Have a great weekend. This is Bloomberg.
From the world of politics to the world of business, this is Balance of Power. Washington, D.C.
Republicans move closer to taking the Senate. Welcome to the fastest show in politics as the Cook Political Report adds to the chorus of voices on this, now moving Montana to leans Republican overnight. We're joined by the Cook Report's Jessica Taylor on her rationale and the new ratings ahead. Donald Trump floats the idea of no taxes on overtime as the candidates return to the campaign trail, hitting swing states after the big debate this week. We'll have more on the campaign with our political panel today. Bloomberg Politics contributor Jeannie Shanzena is with us, Democratic analyst alongside Republican strategist Maura Gillespie of Blue Stack Strategies. It's Friday, and we get started, as always, on Wall Street. The Friday trade with Mr. Charlie Pellet in New York. Hey, Charlie.
Well, hello there, Joe Matthew. Friday rally underway. We're on track for a 4% gain on the week on the S&P. Best level of the session right now with the S&P up 39, 56.34, where we stand now, up by about 0.7%. Dow Jones Industrial Average pushing higher as well, up 420 right now. That is a gain of 1%. We've got NASDAQ up 130, higher by 0.7%. Your 10-year, 3.65%. 2-year, 3.59%. Looking ahead to the Fed meeting next week. Spot gold up $24 the ounce, another record. 25.82 on the precious metal, up 1%. And West Texas Intermediate crude oil up 0.4%. 69.27 for a barrel of WTI. Bottom line here, traders are reviving prospects for a half-point cut next week, spurring a rotation into stocks that would benefit the most from policy easing. Ethan Devitt is Chief Investment Officer at Moneta Group, and on surveillance this morning, she told us the November election extends well beyond the United States.
This is not just a domestic election. This is an election that will have serious implications for trading partners around the world, particularly China and Europe. So in a way, this cloud of uncertainty that is sitting around many U.S. investors today has already, I think, contaminated other investors around the world. And I think for the next 60-odd days, there will be a hesitance around putting on risk positions because we just don't know which way this will go.
Ethan Devitt, and you can hear more of the conversation on the Surveillance podcast. Boeing shares trading lower. Boeing workers walked off the job for the first time in 16 years at midnight, halting manufacturing across the playmaker's Seattle hub. Right now, we got Boeing shares trading lower by 0.3%. In the meantime, American Airlines flight attendants have approved a contract that will immediately raise wages by as much as 20%. American shares, they're also lower, down 0.4%. So again, recapping here, equities higher, S&P up now by just about 0.7%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. Balance of Power continues, the Friday edition. What a week. Once again, your host, here he is, Joe Matthew.
All right, Charlie Pellet, thank you so much. Nice look on Wall Street. Thank you for joining us here on the Friday edition of Balance of Power. You made it to the threshold of the weekend, and we do have news. With our eyes on the campaign, lot to talk about today. We say that every day. And yes, Charlie, at the end of each week, we say, what a week. That's going to be the case straight through the election, dare I say, the rest of the year and beyond. Donald Trump's in California. Ask yourself why. It's not on the list of swing states, but he will resolve his day in Las Vegas, which very much is a late rally, 10 p.m. Eastern for Trump in Vegas. The Democratic ticket focused on swing states today. laser focus on the blue wall for Kamala Harris, Johnstown, Pennsylvania today. Then on to Wilkes Barre or Barry, depending on who you ask. Jonathan Tamari will give us a lesson. And Tim Walz making his way through Michigan and Wisconsin today. You can write this stuff before I tell you where they are. This is what it's going to be for the next 8 weeks, of course, as we consider the idea of whether we'll have another debate. And here in Washington, it just got real quiet. Did you just sail right into work today? They're gone. Again, the House and Senate left town last night without a plan to fund the government, which will run out of money on September 30th. So they came back this week, they got nothing done, and they went home. Jonathan Tamari covers Congress for a living at Bloomberg Government, and he's with us right now. Jonathan, this is a familiar feeling, not only watching everyone leave with no progress, but also staring down the barrel of a shutdown that I keep hearing isn't going to happen. What can you tell us?
Yeah, like you just said, there wasn't much progress this week. There was very little to note that actually happened in the Capitol. You know, they were back from recess, but you couldn't necessarily tell. But there is still feeling there's this tension that there is the election right around the corner, but at the same time, that almost diffuses the tension because there's a belief that no party leader is going to bring their party into a shutdown this close to Election Day with so many races still in the balance. There's a feeling that eventually they'll get to a compromise and it'll be a short-term spending resolution that lasts into sometime into December.
Does this debate jeopardize potentially billions of dollars in federal disaster relief funds? I know Senator Brian Schatz is pretty worried about that. The Democrat from Hawaii, of course, calling for help in Lahaina, where the wildfire took place. But we are in the middle of hurricane season right now, Jonathan. Is this a problem?
Yeah, I mean, it's a problem that Democrats are pointing to, that if you just continue the current spending levels, then you're not going to put in the money, that the additional money that could be needed to deal with disasters that come along the way, that hurricanes and other natural disasters. And it's one of several items where Democrats are saying, look, if you just keep the government running on its current levels, you know, we're not providing some of the things that are needed to either renew programs that are set to expire or things like these disasters. So that's one of their main talking points about why they are arguing against a 6-month resolution that Speaker Mike Johnson has proposed, just saying that it would leave the government on autopilot too long.
Well, so if we kick the can, 3 months, 6 months, I don't know what the duration ends up being here, can you count on then a supplemental request, an emergency funding request for disaster relief, maybe even a supplemental for the Pentagon in the lame duck session?
Yeah, I mean, it's possible they could try to attach it to a short-term bill that passes this month. But certainly at the end of the year, there's a long tradition, as you know, of the Christmas time kind of leading towards compromises. A lot of lawmakers are retiring or they've lost their reelections. Everybody in the building is more or less looking to get home for the holidays, and it suddenly motivates people to maybe cut some deals and reach agreements. And there's a bunch of must-pass things that always pile up at the end of the year. This spending bill would be another one that would get added to it. And it tends to grease the wheels when everybody knows that there's a lot that has to get done and little time to do it, or else they end up staying here for Christmas and New Year's.
Well, Jonathan, I know you're also working the campaign trail and covering a lot of really important races. You might have seen what Cook had to say about Montana overnight. In fact, Jessica Taylor is going to be on right after our conversation here. How many races are you looking at that are going to decide who controls the Senate following this cycle?
I mean, the Senate, there's probably a good half dozen races that are potentials, but the ones that are really at the top are the Montana Senate race that you just mentioned and the Ohio Senate race with Senator Sherrod Brown defending that seat as a Democrat. Those are really the two biggest ones where those are pretty red states, and Republicans have a strong chance of winning. If they don't win those states, then that's almost a political disaster for Republicans. But they're favored to certainly win Montana, possibly win Ohio. And then after that, it gets tougher for Republicans. Democrats are still playing defense just about everywhere else, but they have some pretty tested incumbents in states that are either slightly blue-leaning or pretty right down the middle. But, Pennsylvania, Wisconsin, Nevada all have potentially tough races. But those are just less difficult terrain for Democrats than Ohio or Montana.
Bloomberg Government's Congress reporter, Jonathan Tamari. Jonathan, it's great to see you. Thank you so much for the insights here. This is why so many people are talking about the likelihood of a Republican Senate and maybe a Democratic House. Maybe they both flip in this cycle. The note that dropped from the Cook Political Report, though, is what people are talking about today in Washington. Jessica Taylor writes, quote, Republicans are now an even heavier favorite to win back control of the Senate, regardless of the results at the top of the ticket. That's the important take here. And yeah, we're looking at Montana specifically. As Cook moves the state, this Senate race from toss-up to lean R. This is the Senator John Tester race, of course, running for his political life here against Republican Tim Sheehy. I'm glad to say that Jessica Taylor is with us right now from Cook, Senate and Governor's editor at the Cook Political Report. Jessica, it's been way too long. Congratulations on driving the conversation today. I'm just curious to hear your rationale on this race in Montana. Why?
Well, I think it's just the math eventually catches up with you in some of these really red states. As Jonathan was saying, you have Democrats are essentially playing defense everywhere, but nowhere more so than I think in Montana and Ohio. You know, if we're looking at where the Senate stands right now, Democrats have a 51-49 majority, but we have to remember that with West Virginia, with Joe Manchin retiring, that seat is going to go Republican. So we start at 50-50. So even if Trump were to win re-election or win another term, then Republicans would control that with the vice president breaking the tie. But with Montana moving in that direction, we have seen polling out in the past month or so that has shown his Republican challenger, former Navy SEAL Tim Sheehy, opening up a slight lead. But more importantly, when I'm talking with sources in the state, it's just that Tester, he's sort of been their white whale. You know, he was elected in 2006 in the Democratic wave when they took back the Senate, defeated Republican Senator Conrad Burns. They've run against him in 12. They've run against him in 18 with arguably weaker candidates than they have right now. And they've never sort of been able to get him underwater. Well, his favorables at this point are underwater. And I think just look at this. It's a state that Trump won by 16 points. And in a presidential year, I think if this were a midterm year, it would be a different conversation, like when Tester was able to win in 2018. In 2012, when Obama was atop the ticket, it's a state that he won by 13. And while Tester ran ahead of the ballot by 7 points, running ahead by double digits this time, I think is just that much harder.
Interesting to hear you talk about Montana. Maybe you can speak to why Kamala Harris at the top of the ticket does not move this race the way it might be other down ballot races.
I think it's just that Montana just becomes a redder and redder state. I mean, she's not going to be playing there like they are in other states. And I think that it's just fundamentally, you know, another difference, I think, is that you've seen a lot more conservative people moving into the state from sort of seeking more of a conservative refuge from places like California, Oregon, and Washington. They refer to them as sort of the cows moving in fact. And, you know, Tester's really underscoring that he's been there for generations. But when he was elected in 2006, over half of Montanans were native Montanans. Now that's a little over a third. So, you know, he sort of hits Sheehy as being inauthentically Montana, not, you know, sort of a dude rancher, not a real rancher. But I think with, again, people moving into the state, I think just those Montana roots don't matter as much as they once did.
What they used to call George W. Bush, I think it was the first lady, call him a windshield cowboy. You mentioned Joe Manchin of West Virginia. Boy, you know, Democrats just can't seem to shake Joe Manchin. He's, of course, left the party, an independent now, and he's weighing in on the race in Maryland, which Cook, of course, rates as likely D. That's Angela also Brooks. If you live around Washington, boy, you can't hide from these ads from either of them. So Joe Manchin backs Governor Larry Hogan, the Republican in the state of Maryland. Does it matter? Who's this for?
I mean, that does overlap with sort of the Western Maryland media market there into West Virginia, but I think that's a more conservative area of Maryland. Really, I think what also Brooks has to do is this is where she is incredibly helped by the top of the ticket. We talked about just the lean that you have to overcome in a Trump plus 16 state. Well, Maryland is a Biden plus 33 state. So Larry Hogan would have to pull off just an even bigger feat than John Tester would. Granted, this is an open seat. And yes, he's won statewide before as governor, but fundamentally voters look at a vote for governor and a vote for Senate very differently. And you can see that in the ads that also Brooks and Democrats are running, underscoring that, okay, you may have liked Larry Hogan, but he would be a vote for Republican in a Republican-controlled Senate, and you're going to see them, as you mentioned. We've already seen those on the air here in the DMV media market that they're hammering that home. And I think with about a third of the electorate is Black in Maryland, and she really also really needs to run up the score, particularly in Baltimore. Kamala Harris, a Black woman atop the ticket, certainly helps also Brooks in that regard.
Okay, so that's really important. Think of the difference between what we're talking about with Jessica here, Maryland versus Montana, and the impact that Kamala Harris can have. It's limited, obviously, but this is one of the bluest states in the country. Jessica, and I wonder if Democrats are starting to get nervous. We're buried with ads from both of them, but I read this morning the backers of Angela Alsobrooks have nearly tripled their TV broadcast and digital ad buys this month compared to August. What does that tell you about this race?
Well, I think it's just that Larry Hogan is better known than Angela Alsobrooks, and Angela Alsobrooks needs to increase her name ID, introduce herself to voters. She won that primary over another incredibly well-financed opponent in David Trone, who spent $62 million of his own money.
How true.
But people have been used to voting for Larry Hogan, so you can't take anything for granted. But I think once Alsobrooks just increases her name ID and tells people that she is the Democrat running, that's going to help her.
Interesting. I don't know if a lot of people in Maryland are walking around wondering about Joe Manchin, but I have to ask you about the presidential campaign because I don't get that much of an opportunity to talk to Jessica Taylor here. There's a fascinating piece by Nia Malika Henderson at Bloomberg Opinion, who says Larry Hogan should get involved in the presidential race and endorse Kamala Harris. Now, remember, this is a very strange scenario in Maryland, so things might not seem logical because we're talking about such a blue state. But Nia says that Hogan is running about a perfect race for Senate that a Republican could run in Maryland. He puts it over the top by endorsing a Democrat for president. Is that even possible in your view?
I think that would certainly help him, but I think fundamentally, if he continue, what they're saying in the ads is that, he would still be a Republican in the Senate and would caucus with Republicans. And I think that's the difference that, if he were to say, I'm going to be an independent in the Senate and decide who I'm going to caucus with, that might help him. Yeah. Again, a lot of his ads have been very critical of former President Trump. They've, criticized him for January 6th and different things. Like, if you closed your eyes and listened to some of these ads, you would think they were coming from a Democrat. So he certainly is much farther to the left than your traditional Republican would be. But what Democrats have to hit him on is just that he was recruited into the race by Mitch McConnell and has said that he would caucus as a Republican. So I think the only thing that could possibly change the trajectory is if he says, listen, I'd follow Joe Manchin's lead in the final months and be an independent, and I'd leave it up to, to who I'm going to caucus with.
Really interesting and a great conversation as always. Jessica, we missed you. Come back and talk to us soon. We've only got about 8 weeks left to talk about this, although I don't think it's going to be quite done in 8 weeks. She's the Senate and Governor's editor for the Cook Political Report and making news today, the top of the tip sheets with this move on Montana leans R. I'm Joe Matthew in Washington, and we thank you for joining us here on Balance of Power. We're just getting started on the Friday edition. Did you hear about Boeing and what's going on here? Organized labor looms large in this campaign, and it just got a lot more interesting with a work stoppage at Boeing. We'll have more on that, and of course a conversation with our panel. Jeannie Shanzano and Maura Gillespie will be with us a bit later on this hour. And a little tip for later on, Kaylee's back today. It's all ahead right here on Bloomberg.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg. We are on track for a 4% gain for the S&P 500 index this week. Right now, we've got stocks trading higher. We're off session highs, but still an advance of 28 points on the S&P to 5623, a gain of 0.5%. Dow Industrials up 325 now, up by about 0.8%. And NASDAQ higher by 90 for the NASDAQ Composite Index, a gain now of 0.5%. 10-year yield 3.65%, the 2-year 3.58%. Gold up $25 the ounce. Gold at a record $25.83, now up by 1%. And West Texas Intermediate crude oil up 0.5%, $69.34 for a barrel of WTI. Traders have revived prospects for a half-point Federal Reserve rate cut next week, spurring a rotation in stocks that would benefit the most from policy easing. Uber will be the sole supplier of driverless rides on Alphabet's Waymo cars in Austin and Atlanta, a boost to the rideshare app's ambitions in the autonomous vehicle arena. Today, Uber shares are rallying 4.9%, rival Lyft slumping by 3.5%. Again, recapping, stocks higher, S&P up 27, up 0.5%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Charlie Pellet. Balance of Power continues now. Back we go to Washington, the Friday edition. He made it through the week. What a week. And once again, here's your host, Joe Matthew.
No, you made it through the week. Charlie Pellet, nice outfit, Charlie. I like the pink. I've got to tell you, if you're with us on YouTube, you'll know what I'm talking about. Thank you for joining us on the Friday edition of Balance of Power. I'm Joe Matthew in Washington with an absolutely harrowing tale, being told for the first time about the terrifying moments when a door panel blew out of a Boeing 737 MAX 9. You know, that was all the way back in January when the door plug blew out. A pilot on Alaska Airlines Flight 1282 is talking for the first time about it. First Officer Emily Whiprud with CBS News. The first indication was an explosion, she says, in my ears, then a whoosh of air. My body was forced forward. There was a loud bang as well. The flight deck door was open. I saw tubes hanging from the cabin. Check this out. I did not know there was a hole in the airplane until we landed, the pilot said. It was so incredibly loud, and I remember putting the oxygen mask on and trying to transmit to air traffic control, wondering why I can't hear anything. It would turn out her headset had been yanked off and sucked out of the aircraft. I tell you this story now as the White House makes a phone call to Boeing and the machinists, because we do have news, and it brings us straight to Washington. As Boeing factory workers walk off the job for the first time in 16 years, this has not been a good year for Boeing. We've got the door plug. They happened to strand a couple of astronauts in space while they were at it this year, and it's only September. Members of the International Association of Machinists and Aerospace Workers, 33,000 employees across the West Coast, stopped work at midnight on Friday. I'm glad to say we have George Ferguson with us, Bloomberg's intelligence senior aerospace, defense, and airline analyst, who has been all over Boeing all year. George, it's great to see you. Your analysis will be important to us right now, because the impact on the company, we're told, could be in the tens of millions of dollars. Maybe it's more. I don't know. The company says they still have demand, but we're going to watch major delays here in delivering 737s going forward. What will be the impact?
Yes, I mean, we're starting by looking at third quarter alone, right? And so we expect that we expect the strike not to last that long, because we don't think Boeing can allow it to last that long. So we think that if they're not going to deliver any more airplanes in September, you're probably talking about a $500 million hit to cash flow, as they don't get sort of 15 airplanes at $60 million out the door, which means we expect that they'll probably end the quarter at about $9 billion of cash for the company after they burn like $3.5 billion during the quarter. They bring in a lot of inventory as their suppliers continue to ship to them, because they're kind of trying to keep their suppliers alive. And we think that'll put them somewhere around $9 billion in cash, which is about the bottom of where they can be to run the company. So they may have to come to capital markets if the strike would persist.
Wow. All right. Well, talk numbers if you can. Brian West, the CFO, says They had a target of 38 373 MAX jets a month by year end. Do we have a sense then of what they'll end up with?
I mean, I think it's all going to be predicated on how long this strike lasts. Again, I think that's why Boeing has the largest incentive of the two partners here to get this, to get a deal signed with the machinists and get them back on the factory floor. We don't see any substitute for those machinists going back to work. I do think if we have something that persists for a month and a half or so, it'll start to put the supply base in some difficulty. I think Boeing won't be able to accept their deliveries.